Pullback in stocks, a retreat in treasuries. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Let's take a look at how stocks are trading right now with about 2 hours to go in the session. The S&P 500 has come off its lows after earlier declining as much as 1%, preserving the streak of moves of less than 1%. The last time the S&P closed by at least 1% up or down was about 3 weeks ago, and that was November 14th. Today, you've got tech leading the way down, but interestingly, small caps continue to levitate, led by consumer staples and financials. They were the outperformer at the end of last week as well. Let's take a look at what's happening in treasuries. The 2-year yield moves up by 12 basis points, so there's a sell-off across treasuries, but certainly at the shorter end of the curve. And Romaine, I wanted to end with Bitcoin. Look at that gain of 5%. Bitcoin topping $41,000, also helping lift crypto-related stocks in the process.
Yeah, a bit of a redux for that Bitcoin trade. Not quite the frenetic pace that we saw in previous rallies, but a bit of a slow burn. But I think a lot of people will take it. That is the hot trade right now. Not AI, not Wegovy. It's Bitcoin extending year-to-date gains beyond 150% right now, back above 40,000, back to the highest level since April 2022, back to where it was before the Terra USD implosion. Now, a big part of that rally is, well, simply a clawing back of some of those losses, with a dash of optimism here about the potential regulatory progress on a Bitcoin-related spot ETF here. But you overlay the correlations, and it's clear that the move higher is directly linked to that move lower in Treasury yields and to the growing confidence that the year-plus long rate hiking cycles, central banks worldwide, that hiking cycle is done. But Praveen Korapi, over at the chief interest rate strategist over at Goldman Sachs, he actually says that pricing in roughly 1.25 percentage points of cuts over the next 12 months is insane. That's my paraphrase, not his. But it does suggest the U.S. economy would be on the brink. He says, quote, markets are approaching the limits of what can plausibly be priced in without attaching material odds of a recession in the near term. His team at Goldman, they've penciled in just one rate cut for 2024 rather than the 5 that the market has put in there. And he actually recommends selling calls on the June SOFR contracts as a way to bet against some of the front loading that we're seeing on the pricing of those rate cuts. And that sets up an interesting battle, Scarlett, between market sentiment and the perceived reality that the Fed wants you to believe. The idea that, well, sentiment right now appears to be winning out. We know that here because the idea, and when you look at the latest MLive Pulse survey that we got this morning, Scarlett, 63 of the respondents in there actually say that their returns in 2024 are going to be better than the returns in 2023. How is that possible?
The return of the bull, right?
Yeah.
Well, let's take a look at what might be driving some sentiment there, because U.S. stocks went from oversold to overbought inside of 1 month. This is the RSI for the S&P 500, and you can see by surpassing 70 on the RSI, that is oversold. That resulted in one of the best November rallies ever, which has now led bearish strategists like Mike Wilson of Morgan Stanley to forecast a rocky December for stocks and rates, which, of course, are driving the price action for stocks. So where we go from here depends on investor perception of what the Federal Reserve does next. And right now, it's all about anticipating rate cuts, since Jay Powell seems content with not hiking anymore. Big thanks to our Mike McKee for this chart, which shows that the market is currently pricing in as many as 5 rate cuts by the end of 2024. Some people, Romaine, of course, think it could happen as quickly as the first quarter.
Yeah, let's see what our first guest thinks as we kick you off to the close with Matt Maley, Miller Tabak's chief market strategist. Matt, great to have you here on the program. And let's start off. If you want to make a case as to whether this bull run has legs to it or whether it's going to peter out, I guess you have to establish why we had this rally in the first place, Matt. What exactly do you think drove it?
Well, obviously, this big move in interest rates and the thought that the Fed is indeed done hiking rates has been the main driver. But we also have to remember that, when the market was really oversold, both the stock market and the bond market prices were oversold. Their yields were overbought. But back at the beginning of November, everybody was positioned that way. Everybody was short both of those markets. So even though we've had this unbelievable rally over the last month or so, and a lot of it has to do for good fundamental reasons, this change in interest rates. Some of it also has to do with the position that was involved. And a lot of that positioning has been worked off. So you're not going to get the kind of squeeze that we had in November as we move through the rest of December.
When you see people trying to sort of price in this idea of multiple rate cuts, not just a rate cut in 2024, but you have market pricing basically more than 4 quarter-point rate cuts. And we've had people on this program that seem to be buying into that as well, that we could see anywhere from 3 to maybe as many as 5 rate cuts in 2024 alone, Matt. Do you think that could be justified?
Well, but only if we see a big slowdown in the economy. I mean, that's the big thing that everybody keeps talking about. First of all, the Fed funds futures are a horrible indicator for what's going to happen over the longer term. They're really only really good at what's going to happen at the next the Fed meeting, not further down the road. It changes all the time, and so people that need to be careful of that. Number one. Number two, we have to remember. I guess my concern is that a lot of people are just assuming we're going to go back to the easy money era, where interest rates are just going to fall off the cliff. But that's not the normal thing. We have normalized interest rates. As Stanley Druckenmiller said just a couple of weeks ago, the bond market is pricing in the end of the free money era, the end of QE, the QE era, and the stock market really hasn't done that fully, at least not fully yet. And so when we do see that decline in interest rates, it's not going to go back down to that ultra low level that's going to keep these high level of valuation levels to be justified. It's just going to be much harder to do.
So, Matt, talk a little bit more about the valuations, because you say at 19 times earnings and 2.5 times sales, the market is pricing in something like pre-2020, when in fact that's not what we're going to get, even when inflation moderates and the Fed can take its can start looking into the prospect of rate cuts.
Right, exactly. Again, this value, as we all know, valuation is a horrible indicator for timing. Okay, but on a longer term basis, as I always say, the market isn't actually always right. It's only always right eventually. And this whole valuation thing, I think, has to come back down to a normalized level. And it's one thing that's very important to note. You go back the last 30, 35 years. Every time the Fed has stopped, or what people say, well, every time the Fed stops tightening, is very, very positive for the stock market. That's actually not the case. One time, it actually was very negative for the market. What was the big difference? The 4 times they stopped tightening when the market was very cheap, down near 14 or 15 times earnings, sure, it was very bullish for the market. But the one time when it was expensive, which was in 2000, and the market, like it is today, it was actually not good at all for the stock market. So we need to be very careful about the starting point we have. The starting point we have at this time around, with the end of the Fed rate hikes, is an expensive level, when usually it's a very cheap level. And that's going to make a big difference in what our upside potential is going forward.
Yeah, you always have to look at everything in context. So talk a little bit about the move in Bitcoin. We highlighted how it got past $42,000, now currently above $41,000. That's a short-term bullish indicator, isn't it?
Well, on a very short-term basis, it's had this huge run, so it's probably getting ready. You look at you mentioned the RSI chart on the S&P 500 just a short time ago. It's getting quite high on Bitcoin right now as well. It's also getting, if you look at the Bollinger Bands chart, more than 2 standard deviations above its 20-day moving average. These are all very short indicators, so be a little bit careful about chasing Bitcoin up here on a very short-term basis. But yes, this breakout, especially above that 38,000, the 40,000 number is a nice round number, but that very big break above 38,000 is good on a long-term basis. And the only thing I would just add is that also with gold, you've seen a big reversal today. It's also breaking out, but we have what's called an outside down day, when it trades higher and lower than the previous day's high and low and closes lower. Those usually indicate a short-term top in the yellow metal or in any asset. So I think it's another one where you have to be careful about chasing it near term. But both of them are looking very good on a longer term basis.
Interesting. Yeah, the technical certainly playing that out. Matt, one of the best in the business. Matt Maley, Chief Market Strategist over at Miller Tabak, helping us kick you off to the close here on this Monday afternoon, the start of the week that's going to be a big one for labor market data. Jolts tomorrow, jobless claims on Thursday, and the official government jobs report for the month of October coming on Friday. For November, coming on Friday. We'll get a preview in a second.
Plus, we mentioned Bitcoin, but we'll get you the latest on this year's Bitcoin rally, which came right as gold touched a record high before retreating a bit. We'll take a look at what they have in common. And controversy over at COP28. The president of the climate conference says, well, some of the science doesn't necessarily back up climate change. He says that his comments were taken out of context. We'll discuss in just a bit. This is The Close on Bloomberg. The market is gearing up for a slew of economic reports this week that'll give us the latest read on the health of the U.S. labor market. Bloomberg International Economics and Policy Editor Michael McKee joins us now to break it all down. We're looking past, of course, the factory orders and the durable goods for the month of October, which feels like 10 years ago at this point.
Yeah, the month of October. Well, it's the first month of the fourth quarter, so we do care, but we're finally getting into the November numbers, and that's going to start adjusting things. The Atlanta Fed's GDP now fell to 1.2% for the fourth quarter on Friday, but that is with only October numbers. So we'll see how things go in the coming weeks. And you're right, this week will be a busy one. Tomorrow we get the JOLTS report. We get the job openings and labor turnover survey, and it's not expected to change a whole lot, down 235,000, which is going to still leave us above 9 million and leave a lot of questions. Wednesday we get the ISM Services Index and employment. Thursday, ADP and the jobless claims numbers. Wednesday is ADP, jobs claims, and then of course on Friday we get jobs. So if you're going to
what's the
trade on...
well, what's the wind up to that? Because we've paid so much attention to JOLTS and ADP numbers over the last year and a half, even though historically they haven't always been the best, I guess, preview of what we actually get in the monthly numbers. Has that predictive power from those, is that waned?
Well, neither one has had a lot of predictive power. The reason people looked at JOLTS was because Jay Powell looked at JOLTS and he said that this meant that the labor department, the labor market was still pretty tight because there were lots of openings out there. Now the labor market may have loosened some. We're seeing lower hiring numbers forecast for Friday. And it's been long enough that it probably doesn't matter as much to the markets. ADP is its own unique creature. It's gone through 3 or 4 different iterations. Each time it doesn't predict what is going to come, but Wall Street trades on it anyway because they want to trade on it. So it'll matter.
If you want to trade on the prospect of a Fed rate cut as soon as possible, are you rooting for disappointing data then? You're rooting for data to miss, aren't you?
Well, there's 2 different camps. There's the recession camp. If the data misses and people think that we're going to keep going, slow down into contraction, then you're anticipating a fairly quick Fed turnaround. But there's also the things will be a relatively soft landing, and what's going to happen is inflation will keep coming down, and that'll push up real rates, and the Fed will address that to keep the overall tightness of monetary policy about the same. So you pays your money, you take your choice which camp you're in. But at this point, it's kind of 50-50 because there are people who see this slowing economy and say it's just going to keep going. Historically, that's what's happened. And others say, no, the Fed's going to pull this off, and inflation's coming down faster than we anticipated, so then they'll be able to cut. The Fed itself said they would cut in 2024 at their September meeting. They're going to update that December 13th, so we'll find out.
Okay, you think they're going to have 5 times in there?
I don't think they're going to have 5 times.
All right, Michael McKee, our chief international and economics correspondent here. A look ahead to what's going to be a busy week for labor market data. And I know a lot of people poo-poo the JOLTS data, particularly given some of the anecdotal evidence that maybe some of those jobs aren't actually real. But there's some other numbers underneath that headline number, like the quits rate and other things that I think have been pretty telling to see that increase in quits rate has basically plateaued and is now starting to come down, which would suggest a little bit more tightness in the labor market.
Yeah, as we wait for inflation to get to that 2% target, everyone's scrutinizing the granularity of the labor market, looking for any kind of clue that the labor market has slowed down enough for inflation to start following suit as well. I guess the big question here is maybe the outlier is what happens if the economy starts picking up? Is anyone talking about that?
No. That's why there's 5 rate cuts priced into this market, but it does get to the
risk,
but it does get the idea. I mean, and how many strategist notes have you seen over the last? Basically saying that what's being priced into the market and the market sentiment right now is probably way over the skis. That's not necessarily saying they're predicting the complete opposite of what the market is pricing in, just saying that maybe that trade has gone a little bit too far.
Maybe not 5 rate cuts.
Too fast, meanwhile, another trade that seems to have gone pretty far, and well, whether it's gone too far remains to be seen, and that's Bitcoin. The latest on the Bitcoin rally coming up after the break on the same day that gold actually touched a record high intraday. That conversation, where do you hedge, Bitcoin or gold? This is The Close on Bloomberg. All right, let's go back to that Bitcoin rally, the digital currency up about 150% year to date. That rally driven by optimism that the SEC will approve a spot Bitcoin ETF, and maybe because the Fed might actually be done with rate hikes. Mike Regan joining us right now, Bloomberg senior markets editor, to talk a little bit more about what's been driving this rally. And I've seen a lot of different narratives here. Some peg it to the drop in Treasury rates and the idea of rate cuts coming by the Fed. Some people, again, point out to spot Bitcoin ETF and progress on that. And other people say, well, now that, CZ and SBF have been dealt with, and now the clouds over Bitcoin have somehow sort of opened up and people can go back to the trading like they do. Pick one for me.
Yeah, right. Well, that is a common theme, the turning of the page after Binance. But I think, when we first saw this pop above 40,000, everyone sort of latched onto that macro narrative, lower yields, the Fed's done, we'll have more liquidity, less inflation next year. But I think that has sort of gone by the wayside as the day's gone on, simply because the rest of the markets aren't sort of reacting that same way. Stocks are down, yields are back up. Gold, which went above 2,000 overnight, is back down. So I think people now are really focused on sort of the crypto-specific catalysts. That ETF approval just feels like it's got to happen soon, within the next month or so. And also, a real Bitcoin-specific thing is what's known as the halving, and this gets complicated.
Well, before you get to the halving, though, just on the Bitcoin ETF thing, I mean, that's been largely kind of funneled by kind of the BlackRock filings and other things, or is there more to it than that?
The BlackRock filing was a huge part of that, but also, if you remember Grayscale, who runs the GPTC, the fund that wants to convert into an ETF, scored a major court victory earlier this year that most people believe pretty much leaves the SEC without really a leg to stand on and denying it anymore. So the feeling is that these ETFs are inevitable, right? But really, that's been the story for months now, and Bitcoin was rallying. It kind of hit that wall at about 38,000. Just seemed to hit some resistance there for about a month. But then once it pierced through that 39 and then 40, it just really, is staying there and really above what I think people thought would be a little bit resistance at 40,000 now.
This is what's called the momentum trade. And is there evidence of more momentum during Asian trading hours or European trading hours than in the U.S.?
It certainly seems like it, just anecdotally looking at the time when this rally happened. It was dinner time, New York, Sunday night, the beginning of the trading session in Asia on Monday. So, Bitcoin trades 24/7. So there's nothing stopping U.S. investors from buying at a Sunday dinner time, but it kind of seems unlikely. You're going to turn off the NFL to go buy Bitcoin. It seems, anecdotally, it feels more like an Asian sort of driven thing. Maybe them trying to get ahead of the week, knowing that, the narrative is the Fed's done, dollar's weaker, yields are lower, today notwithstanding, and really just trying to get ahead of that.
Well, if you're an Eagles fan like you are, Mike Regan, maybe you do want to
turn that off,
There you go. All right, and trade Bitcoin. Mike Regan, thank you so much, Bloomberg senior markets editor. Let's turn now from crypto to gold, which briefly shot past the previous all-time high of $2,100 earlier today. Gold futures and spot gold now falling, however. For more on gold, let's bring in Mike McGlone of Bloomberg Intelligence. Mike, you heard what Mike Regan was saying earlier about Bitcoin. Is there a correlation, is there a relationship here between the rallies that we've seen in both Bitcoin and gold?
Well, hello, Scott. I think there is. I think Mike was spot on, the other Mike. The key thing that's happening with gold today, it did make an all-time new high. You mentioned that. On the terminal shows $2,135 at all-time new high. It's coming back a little bit. And now it's about, can it hold that 2,000 level of which was resistance and convert it to support? I think it will. But the unique thing about today is despite a higher volatility risk-off day, that chief risk-on asset, Bitcoin, is actually going up. So I think it's telling us, at least from a one-day standpoint, showing us that the market going, the world going digital. I like to say if you're holding gold and you're bullish gold, you kind of have some Bitcoin in that space, and today it's proving that.
I am curious about some of the technical levels. We were speaking with Matt Maley earlier, Mike, and he kind of pointed out, and I kind of missed this, the idea that you're seeing highs today that are higher than last week's highs, and lows today that are lower than last week's lows. What does that tell you?
Well, obviously that's a bullish side, Romaine. It's clearly bullish, but a key thing I think you point out is a lot of Bitcoin trading happens in Asia, and part of that is the global bent and tilt. They don't have the easy access to the dollar that we have become accustomed to, and we're privileged to. So they need something else and something more active. And typically, if you look at China, they love to trade, and there's a great, they love gold, but Bitcoin's the digital version. So you're seeing that. But the key levels are, it looks like they broke above that 30,000 level, and now it's knocking around. But again, it's ETFs. The difference with gold is the deepest pockets on the planet are buying gold, central banks, and they still are doing that. Now, the question is, what stops them from doing that? I think it's going to take higher prices.
I'm glad you bring up China and demand from overseas, in particular like China, like India, because seasonally there is something to the price of gold getting bid up. You've got the Lunar New Year coming up as well, right?
Yeah, so December and January are the best months for gold, bar none, going back 20 years in a Bloomberg terminal. We have this great function, SIG, and it shows, I think, on average, it's 2 to 3% those months. So this is usually a good time. But it's also, to me, the key thing, Scarlett, is I look at gold, and it trades at a substantial discount to the S&P 500 if you look at the per ounce price of gold. And any time in history, we've been in a substantial discount, most notably since we came off the standard, gold standard in 71. When gold's at a discount and we go to recession, gold usually just catches up to the S&P 500. To me, that's where it's starting to tilt. It's an all-time new high. We're not seeing that in the S&P 500. Haven't seen that for 2 years.
Yeah. All right. Well, Mike McGlone, I really appreciate your joining us today. Mike McGlone wrapping up our segment on gold prices on the heels of the rally in Bitcoin as well. Romaine, with gold prices near record highs, I was just reminded my mom asked me whether she should sell some of the gold jewelry that her relatives handed down. She's like, where is gold prices? And I don't know how much you can extract from a piece of gold jewelry into the actual, spot price of gold.
Yeah, but every time you get to these levels, you always sort of get that kind of retail cohort that realizes, hey, maybe I can cash out and cash some of this in. But it gets also to the idea of what's the true store of value, right? I mean, is it something like a physical metal like gold or silver, or is it going to be something like a digital currency like a Bitcoin? I think one thing we know is that Bitcoin, in theory, at least, is going to be a lot more liquid.
Yeah, well,
I mean, you don't actually physically go get your chain and take it to somebody to melt it down.
To melt it down and then give you, take a piece of the pie for themselves as well while they translate it into a dollar amount. Yeah,
have you
for
ever
sure.
met a gold dealer?
Something to look into. All right, we've got a lot more coming up. This is The Close on Bloomberg.
This is the countdown to the close here on this Monday afternoon. Seeing a bit of a pullback in equities, a bit of a pullback in treasury prices, and a really intriguing pullback right now going on in the metals and energy space. Let's get over to Abigail Doolittle, who's standing by right now with our commodities close. Abigail.
Yeah, that's absolutely the truth. We have the Bloomberg Commodity Index overall down more than 1%. This is the dollar is up 0.5%, more than 0.5%, heading to its best day since mid-October. And to Romaine's point, well, take a look at New York crude continuing the sell-off after the OPEC Plus production cuts of 900,000 barrels per day. Not enough. Even today, Saudi coming out and say that it could extend past Q1. Traders seem not to care. Natural gas also lower, down 4.4%. And of course, the strong dollar hitting both. But natural gas, we have some warmer weather, not just here, but also in Europe. Demand seen in Europe as being weaker. So European natural gas weakness weighing on natural gas here, plus the warm weather here. As for the metals, well, here it is, copper and gold. And I know that you all were just talking in depth on gold. I can't help but want to weigh in because the technicals on gold have a very clear message. And right now, gold heading to its worst day since March. So this is a longer term chart of gold, and this is a long term range. I would point out the RSI becoming extremely overbought over time. Once it starts to go down, you can see that gold reliably dropped back down into this range. Well, this last euphoric peak, well, it was so euphoric, so strong in terms of the buying, went right out of the range, hit that new record high, now back deeply into the range, filling a gap. Take a look at the RSI. It's going back down. It would not be surprising to see gold very quickly back down in this 1800 range, even all the way back down toward the bottom of the range, given the fact that it's been quite some time since it's been there, Romaine. So the gold bugs, well, I think that there might be some pain ahead.
Yeah, definitely an intriguing setup there. And now you talk about gaps to fill on both the upside and the downside. We're going to stick with commodities here and get the latest from the UN Climate Conference, where a little bit earlier, Bloomberg Bloomberg had a chance to sit down with Fatih Birol, Executive Director of the International Energy Agency, and we asked him if the current pledges by oil companies to cut emissions are going to be enough.
I believe they have to make a decision, those companies. Are they going to partner with the rest of the world to address the climate change by having some real commitments, or are they going to continue with their current plans, which do help to increase the emissions causing climate change? They have now there is a moment of truth, as I say to them. And when I look at the current discussions, there are some good signs, good steps in terms of methane emission reductions, for example. But I would like to see more, at least on two areas. One, they have to make sure that they clean up their Scope 1, Scope 2 emissions, the emissions coming from their own operation, extracting oil, refinery, and so on. There is a room for that. This is number one. And number two, they have to make investments also for clean energy technology. When you hear the views, or when you interview the CEOs of the oil and gas companies, they speak 80–90% about the clean energy. Right. But when we look at the investment numbers, which we do at the IEA, only 2.5% of their all investment go to clean energy, and 97.5% go to their fossil fuel operations. So there's a big contradiction between those two.
Well, Fatih, I mean, you said you want a strong signal, you want a real commitment. So come the end of COP, does that mean that some of what you just alluded to in the final text, I mean, what does that look like come December 12th?
So I would like to see two things. I want to see many things, but at least two of them are important in this context. For oil and gas companies to make a commitment to reduce their Scope 1, Scope 2 emissions coming from their own operation, which is equal to all the emissions of the United States, about 15% of global emissions, to reduce them by 60% by 2030.
Fatih Birol there, the executive director of the IEA, speaking over at COP28, which is taking place right now in Dubai. And the fact that it's actually in Dubai has raised a lot of questions as to whether that was the appropriate place. In fact, some controversy actually bubbling up over there after the president of COP28 made a reference to there being no science behind demands for a phase out of fossil fuels. Now, we should point out that he did, Scarlett, clarify his comments to say they were kind of misrepresented, and he did double down on this idea here that they remain committed to guiding the world down to that 1.5 Celsius degree target that COP has been chasing.
Okay, Sultan Al Jaber, yes, he is the president of COP28, but he's also the CEO of the United Arab Emirates state oil company, ADNOC. Really? So that presents an interesting conflict of interest, doesn't it?
It does. And, you know, I want to be fair to him, because when I first saw this headline over the weekend, everyone was really sort of making
taking it back.
But I did go and look at his full comment. And it should point out, A, he was kind of pressed on this by the person asking questions. Two, he gave a much longer answer. And even everyone just cherry-picked the no science behind it. But he was just saying that the phase out of fossil fuels, in his words, he said, is inevitable. So he's agreeing with that. He's just saying that achieving that 1.5 Celsius degree target isn't going to be achieved through the elimination of fossil fuels alone. And he was questioning whether the science underlying this idea that fossil fuels alone would get there, whether that was sound. So he wasn't questioning the science of climate change per se, but it still doesn't really get to the optics of why the head of a leading fossil fuel company is leading.
Right. I mean, it goes back to the whole point about why are they hosting COP28. But his basic point being you can't flip a switch and make sure it happens that way, right? It's got to be a phase out, a slow, long phase out, not something over the next 2 years or 3 years.
And I think I don't want to defend him, but I do think it's interesting, too, because we talk about how there's really been kind of one big side of this argument on climate. It's like we must do something and we must do it fast.
And we're behind,
And there are a lot of people, they have a vested interest in fossil fuels, and they're saying that maybe there's a bit of a more slow walk there. Whether you agree with them or not, that's open to debate here. But you kind of understand where he's coming from, given his other day job.
Yeah, absolutely. He's still going to be doing that after COP28's over. All right, we have a lot more coming up on the close. Still ahead, mostly in line third quarter results led Victoria's Secret to its best monthly performance in almost 2 years. We'll take you through the numbers next. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with General Motors, an upgrade today to buy over at Mizuho, which says investor concern about weak consumer trends, that 25% wage hike for union workers, and that slowdown in EV sales. Those are all now reflected in the stock's 10-year valuation lows. The analyst does see some additional upside from last week's announcement of the biggest stock buyback ever at the automaker, shares up 2% on the day. Let's stay in autos and take a look at Carvana, getting raised to neutral from underway over at JP Morgan, with the analyst saying improvement in the auto dealer's core retail operations are likely to be sticky. He adds that Carvana can possibly navigate through macro uncertainty in a way that limits some of the downside risks. Those shares having a phenomenal day, 13% in the green on the day. And finally, Lululemon. Wells Fargo abandoning its overweight rating, cutting to equal weight. It's a valuation call, and the analyst says that stock is no longer cheap, and he advises investors to take some chips off the table. Nike has now replaced Lululemon as his top picks list. Shares of Lululemon down about 2% on the day, and those are some of our top calls. We want to stick in the retail space here and take a look at Victoria's Secret. It has been on a mission to be viewed as a more inclusive brand. While it missed EPS in the third quarter, sales trends did show some improvement month over month and into November. Let's get some perspective out of Adrienne Yee. She's Barclays U.S. Senior Retail Analyst. She has an equal weight rating on the shares, though she did recently raise her price target to $25 from $17 a share. And let's start off with the move in the share price, Adrienne. I mean, just since the start of October, we're talking about an 80% gain in this stock, and I know that doesn't begin to sort of claw back some of the losses that it had prior to that. But what's driving this? Is there something fundamental? Is this the rebound story that investors have been looking for?
So it is a very mixed bag. And what I would preface the entire conversation with is that generally retail is now in favor. You know what I mean? We've talked much about kind of how clean the inventory is, the freight recapture, all these below the top line margin drivers. And you're seeing that come through. And Victoria's Secret was not the exception, right? They got the freight recapture. They did come in line on sales, a little bit better on gross margin. And then they missed on SG&A because they were doing all of this Victoria's Secret World Tour and these investments, right, to regrow the brand. You don't see many people missing on the SG&A line. What I would also say is they gave, guidance for the fourth quarter where sales would actually grow again. Yeah. And again, if you dig deep into the numbers, it's coming from the acquisition of Adore Me, not from the core business.
Well, I wonder if you could break that down a little bit more, because I did see that, and we should point out it's still relatively a low growth. I think like 3% or something was the aggregate estimate that analysts have. But even going forward, we're still talking about low single-digit gains, and in some cases, most analysts are predicting that they go back to revenue contraction.
Yeah. I mean, the fourth quarter, the composition of that kind of low single-digit total sales that you just talked about, it's 4 percentage points of growth from Adore Me. It's 4 percentage points of growth from the 53rd week, which we know is just an accounting convention. And then it's low to mid-single-digit growth at the core Victoria's Secret. Victoria's Secret is the animal that runs the entire stock in the company. And so if you cannot get momentum to improve on the top line, right, while you're turning this business, I think that's, these brand reinventions are not easy. And we had mentioned earlier that they're kind of straddling kind of who they were and who they need to be this next generation.
I think that's an important point. Is there something to be said for a nostalgia play? The 90s are back in fashion again when you look at clothing choices, and Victoria's Secret had its heyday back in the, mid to late 90s?
Retro is good insofar as the generation that is now buying sort of embraces that. And I think the tough part about this is that heavily kind of stylized Victoria's Secret angel is just from a politically correct standpoint, it's really not sort of the look and the feel and the branding, the brand message that, is sort of winning in this environment. It's much more about body positivity, being comfortable with yourselves. And aside from the messaging, we really have to go back to how does the new generation of young women who are growing up how do they want to be kind of like marketed to? And it's really not that kind of like circa when they were at their peak in the mid 2015-14 time period.
What do you anticipate will happen when Skims, Kim Kardashian's shapewear brand, goes public, if indeed it does? Bloomberg has been reporting that it's considering a 2024 IPO, and Skims is kind of a competitor here to Victoria's Secret.
Very much so. What I would say about Skims is they came from a brand category that, frankly, I think Victoria's Secret missed, which is the shapewear piece of it. So they've established themselves and they've built credibility in this shapewear, right? Making you look, just fantastic as best as you can. And now they're morphing into bras and underwear. And I think that's a very strong position from them to be marketing from. I mean, Kim Kardashian, as we all know, is the marketing genius, and she has a huge following. I think that the capital and the growth of that piece of the business is indeed, something to watch out for, and could very well be a significant competitor to the Victoria's Secret brand.
All right, Adrian, always great to talk to you. Adrian Yee over at Barclays, a closer look at VS CEO. The shares staging a pretty good rally, but maybe not long for this world. Some breaking news crossing the wire just a little while ago. This in the AI space, this involving Mistral. This is the European AI company that's really only a year old, now nearing a $2 billion valuation. This, according to people familiar with the deal that Bloomberg reporters have spoken to. The latest funding round includes NVIDIA and Salesforce, a funding round that now values the OpenAI rival at about $2 billion. A lot more coming up here on The Close. Stick with us. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, he joins us every day around this time. And David, you always come with some interesting conversations. And today I think we're going to focus a little bit on defense contracting, but also a relatively new CEO who is taking over a company that is a lot more consequential than I think most people realize. Not a household name, but very critical in the world of defense.
Exactly right. SAIC it's called. And exactly right. It is quite consequential. And we do welcome now Toni Townes-Whitley. She's Science Applications International CEO as of, I think it was October 2nd, Toni. And first of all, I want to congratulate you on that, and congratulations on the earnings that came out today. Your stock was up about 10% last time I checked. You had really good earnings and a forecast going forward. And I guess one question I have is, we spend a lot of time around here talking about what's going on in the defense industry and the spending we have to do because of the geopolitics. How much of your success that you reported today really is tied into increased defense spending?
Yeah, look, I would say that I wouldn't tie it to a single activity, but I would say that yeah, we do have some ramp up on some previously awarded contracts, but also we do have signal for customer spending in the defense and national security space. We've got a really good labor environment where we've had low attrition. There's a tailwind across the industry of which we are a part of, but I'm super proud of the triple beat and, quite frankly, 11 quarters of beat that this company has logged over time. So
the tide may be rising for all the boats, but how do you distinguish your boat from the other boats in that environment?
It's a great question. So when you think about SAIC, for over 50 years, they've been leveraging science, engineering, computer science, technology for the mission, if you will, national security mission, whether that be on the defense and the intel community and some of our civilian agencies. In effect, what we do is integrate the most emerging technologies into a very complex mission, real-time operation. And we do that in a very secure way. So when we think of the desire for the Department of Defense, which has been stated in the National Defense Strategy, to quickly acquire more and more commercial technology, an organization like SAIC is a trusted partner and integrator with the Department of Defense and other agencies to integrate that technology using the most open systems of architecture so that we can plug and play across a number of different sources. And that's what gets speed to mission. And that's what helps, quite frankly, our forward deployed troops and all of our warfighters. Certainly so. You've certainly been a very trusted company for the department for years now. I am curious about your trust, though, in the process. We know there's been a lot of disruptions in the procurement process, both for the Defense Department as well as with other agencies here. How are you addressing those issues right now and making sure that you can provide some consistency and continuity for your business? Well, look, part of it is being very clear about what we're building towards. So we've been focused on differentiating our ability to integrate in the most open architecture possible. And I keep coming there because innovation. We all want to see more innovation in our military. We want to see more innovation in our national security and securing our critical infrastructure. But that action requires the ability to integrate lots of different products and capabilities, some proprietary, across a number of different sources, and quite frankly, in the war theater, across a number of different coalitions. That is the sort of digital engineering, cloud capability, data science, artificial intelligence that we've been focused on. We feel good about our ability to integrate. We've heard from our customers that's sort of sending that buy signal to us of how we focus on the mission, leverage right there at the edge of that mission, and bring in technology from every source.
You're in a space where a couple decades ago, even a decade ago, this was primarily a space that was dominated by, I guess, dedicated defense contractors, if you will. But as I'm sure you know, you have a lot of big software companies like Microsoft, even companies like Amazon that have now tried to come into this space with relatively varying degrees of success. I'm wondering what your approach is to that sort of new set of competitors that maybe doesn't have the same constraints that a pure play defense contractor would have.
Well, as you know, David, I'm just leaving Microsoft after 7 years of running their U.S. business in regulated industries. And so when I think of a company like SAIC, they're sitting at the intersection of mission data. This is all about the data that supports decision analytics, the data that we can reason over with artificial intelligence, the data that, quite frankly, can be infused and changed and upgraded for various weapon systems. And so as that data decouples from hardware or platforms, there's a more enormous drive, and organizations like SAIC to understand that data, to build solutions with that data in mind, secure solutions, and to integrate with the data. This is why this industry is starting to shift as you start to see the role of data and software relative to the traditional role of, let's say, hardware and platform.
Tony, you talked about emerging technologies. You can't use those words these days without triggering questions about generative AI. Do you have a sense, do you have a theory about how they may affect your business?
You know, I was just at the Reagan National Defense Forum having this conversation and listening to this conversation with many of our military leaders. Look, I think there's a range of artificial intelligence capabilities. I know there's a lot of focus right now on generative AI, human in the loop. And we're finding that, quite frankly, the data underpinning AI is where we have been focused on those data platforms, because you have to have excellent data quality, excellent data taxonomy to make sure you're reasoning over correct data in correct protocols. And oh, by the way, data from various levels of classification. So will generative AI be here to stay? Absolutely. Does it have an offensive and defensive component for Department of Defense and other national security? Absolutely. It's SAIC's role to make sure that what's happening at the state-of-the-art of generative AI can quickly and securely be integrated into these critical real-time mission operations. That's what we're good at, and that's where we stay.
Tony, one last one. I fear that it requires a longer discussion. I hope you'll come back and have it. But just to start the discussion, I think of areas like technology, where there's a right and a wrong answer, as perhaps a way to avoid some of the problems we've had diversity in the past. Is that true, in fact? Because typically you'd think when it's a matter of math, when it's a matter of science, it shouldn't matter what color you are, what gender you are.
Well, look, when I think about it in terms of the ability, I see technology possibly being the great democratizer in terms of talent. There's so much talent we can tap into in, if you will, in the emerging technologies. We can use the technology to go, if you will, to remove bias out of systems and out of processes. We can also use the technology and provide, if you will, STEM capability and training and efforts to bring more and more individuals who have not traditionally been in that part of the spectrum, part of these organizations and into tech. I think tech can be sort of the new currency, and it can drive us to a much more diverse outcome. In fact, our mission statement says diverse tech with diverse talent, and that's what we'll stand on.
Tony, thank you so much, and congratulations once again on those earnings. That's Tony Towns-Whitley. She's Science Applications International CEO. Tomorrow, we're going to hear from Aaron Chatterjee, Professor of Business and Public Policy at Duke University, about the prospects for 2024. And then on Friday on Wall Street Week, we'll be joined by Honeywell CEO Vimal Kapur. That's at 6 p.m. New York time on Friday.
And of course, you can catch David Weston every day around this time for our Wall Street Daily segment here on The Close as we round out into the final hour of trading here on this Monday afternoon. A big pullback in big cap tech stocks, a bit of a bid for small cap stocks, but the Treasury rally on pause, at least for this Monday afternoon here, and a big pullback going on right now in the commodity space. A lot to break down. We'll do it for you after the break. This is The Close on Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Scarlett Fu. And when you look at the markets, Romaine, really interesting. Once again, you have small caps outperforming. I know we go on about this a lot, but it's a change.
Yeah, it is a change. And we talk about the differential that we're seeing in gains between the Russell as well as some of the big cap indices here. You see that dynamic playing out today, but that's really been the dynamic now, really for the last 6 or 7 weeks now. You can see that right there with the Russell up 0.8% and the Philadelphia Semiconductor Index down by almost 2. Interesting rally also in Bitcoin on the day, and then we talk about the big move in yields. Now those yields moving back higher here on the day, but this just goes back to some of the oscillations that we continue to see. I'll flip up the board here because to your point about the differential that we're seeing between small caps and big caps, this also gets to the whole question about value over growth, and that value trade, quite frankly, just isn't there. So despite some of the outperformance we have seen by the Russell here, there's still a lot of catch up. This chart that you're looking at right now, basically taking the differential between Russell value stocks and Russell growth stocks here, and growth stocks, as that chart is showing you right now, still continue to win out.
Yeah, a lot of financials in that value section, of course, of the Russell 2000. So you put it all together, and when I look at some of the individual movers, it's still big caps very much on the minds of investors. And Uber is a big cap stock that's about to be added to the S&P 500, set to join the index before the start of trading on December 18th. So that gives us about 2 weeks. Interestingly, Romaine, it'll be added to the industrial sub-index.
Yeah, I don't know. I mean, I feel like it should just be added to, I don't know.
Consumer? Tech?
I don't know.
It sees itself as a tech company.
Well, everybody sees themselves as a tech company. I mean, it's a taxi company. So, but anyway, I mean, look, I mean, good for them. I mean, this always will give the stock a little bit of a pop as people try to front run that inclusion. And of course, once it is included, then all of a sudden you get all the funds which have to follow.
All the passive money.
Yeah.
Speaking of another industrial, Alaska Air agreeing to buy rival Hawaiian Holdings for $1.9 billion in cash and debt. The big question is whether regulators will let this go through.
Yeah, I don't know if you've ever flown to Hawaii, but there's basically like one game in town, more or less. So it'll be interesting to see how regulators view this. Obviously, these are much smaller airlines, and sometimes they tend to be a little bit more forgiving of those types of tie-ups, particularly because Alaska does serve a very distinct market, and Hawaiian serves another very distinct market. So I don't think there's a whole lot of overlap that's being taken out of the system. But
that's the argument right now. But of course, regulators are in the final process of coming to some kind of decision on the JetBlue purchase of Spirit Airways as well.
Well, I think you have the final arguments in that DOJ case are either today or tomorrow.
Exactly. All right, let's also take a look at Spotify, up as much as 11% after the company announced it is cutting jobs. And this is all part of trying to get its margins back in line to about a 30% target and operating margins to 10%.
So this is the year of efficiency, right? Everybody laughed at well, no, but they laughed at Zuckerberg, laughed at Meta, and a lot of jokes made over it. But now every company seems to be jumping on board because they realize, look, they can cut a lot of fat and still preserve their margins, cut a lot of fat, still preserve their revenue growth. Maybe
they like
Spotify
the reaction from the market.
We are 1 hour away from those closing bells. Our cross-platform coverage of today's top stories, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Scarlett Fu. We're joined right now by our colleagues Carol Massar and Tim Stenovic. A big welcome to all of our audiences across our Bloomberg platforms, television, radio, originals, and our partnership with YouTube. Happy Monday, Carol Massar. Happy Monday. Unless, of course, it is Monday, right?
It's Monday.
Oh, okay, just checking. I never know
like
with Carol.
Monday.
I mean, she's only here 3 days a week.
Stop
so maybe she's
that. I am here a lot.
Okay, that's true. I won't argue with that.
Okay.
Just not every day.
All right, so should we talk about the housing market? Because we've definitely seen the slowest housing market in a long time. And we're hearing from different players within the sector about the impact that is having. And if you think about growth in the economy, we're worrying about maybe what kind of recession. Do we get a recession? Is it easy next year? But, those plunging U.S. home sales are definitely having a ripple effect on consumer spending. Fewer Americans are moving into houses that need to be outfitted with furniture and appliances. We're just not buying that stuff, Tim.
Okay, so think about
Except for you.
Yeah, well, that's because we recently moved. So the average household spends about $8,000 more on home-related goods and improvements in the 2 years after buying a home, Romaine. That's according to a recent study from folks over at Northwestern's Kellogg School of Management.
Yeah.
But if people aren't moving, then they're not buying those new refrigerators. They're not buying those new couches. So you see companies that make these, quote-unquote, durable goods actually filing for bankruptcy, reporting that they're going to have fiscal years that where revenue actually falls over the last year. It's not the entire economy, but it's an important part of the economy.
It's not the entire economy, but it is a big part of it. And I do wonder whether this is kind of something we're going to have to live with for an extended period of time, because even if rates do tick down a little bit, mortgage rates tick down a little bit, there's still a big affordability factor. And I can't remember exactly where the data came from, but there was a stat floating around last week about the percentage of Americans and the median income that you need to buy a home, and the idea that the majority of Americans fall well below that threshold.
I wonder to what extent there's going to be a little bit of pickup in buying things for separate dwelling units. What are those things called?
ADUs.
ADUs, yes,
accessory
exactly.
dwelling units. Big in California right now.
They're in California, and it's picking up steam in other parts of the country because there's just no availability of homes. So at some point, you're going to maybe buy a smaller refrigerator. All right, what we're taking a look at,
those
of course.
ADUs, we're just talking about what, like a garage apartment, like the Font?
No, I mean, what they essentially did was they changed single-family zoning in a lot of parts of California to allow people with yards to actually build other units to help solve the housing crisis. And, you know, people are building them, and they're
like
still,
above
guess
your
what?
garage or something?
Yeah, above a garage or even a freestanding one, and they're still expensive.
And in the backyard so that someone can get their own house. Let's move on to M&A, because it is M&A Monday. If you look at what's going on in the airline sector and in the pharma sector, Alaska Air buying Hawaiian Air for $1.9 billion in cash or debt. We were just talking about the big question mark is whether regulators allow this to go through.
I'm waiting for the regulators to weigh in to tell us whether or not they're going to allow it to go through. It's a good question, and you know, you have executives from Alaska and Hawaiian saying, okay, well, this actually is good for consumers. But Carol, I'm wondering, you know, of course they're going to say it's good for consumers, but I'm wondering about some examples of consolidation in the past where ticket prices have actually gone down.
Yeah, I think it's kind of interesting. You're going to have to look at routes, whether or not there's a lot of overlap, and what it means in terms of, I mean, I know Hawaii is certainly facing a lot more competition with Southwest when it comes to flights to Hawaii, so they're going to have to look into what is the impact on consumers. Romaine, what I find interesting is that M&A globally still down about 21% year over year. It's down about 16% in North America, down 28% in
You're surprised
in
by that?
No. But I'm just saying it's dramatic.
It is dramatic. Well, you have the regulatory environment we talk about, but it's also the issue of affordability. I mean, you know, who has the cash and the stock prices to really support a major acquisition like that? And then there's also the question of whether investors want that. We were talking on the television program about kind of the year of efficiency and a lot of the cost cutting. M&A doesn't necessarily play into that strategy for a lot of folks. And the idea is that, well, if you can sort of make it organically, that's what you need to do. I don't know. And then as far as Hawaiian goes, I don't know. This could be a little bit of an arbitrage, too. I mean, it's going to take a long time for this deal to even get approval. And I don't know, maybe you have different regulators by the time you get to that threshold.
Yeah, that's a really good point. Could it change and the regulatory environment kind of ease back a little bit? All right, well, we will certainly see. Hey, guys, that's a wrap. We're going to come back in less than an hour's time. We're going to count you down to the close on this Monday. Our cross-platform on radio, TV, YouTube, and, of course, on Bloomberg Originals Beyond the Bell. We'll see you at 4 p.m. Wall Street time.
And we continue our markets coverage right here on The Close, counting you down to those closing bells, which are just about 50 minutes away. Our next guest says with all the focus on AI and tech, now is the time to buy into emerging markets. Elisa Corcoran is Deputy Chief Investment Officer over at CorporateNet Global Investors. She joins us now to talk a little bit more about some of the opportunities that people are finding in emerging markets. Elisa, great to have you here on the program. We've been talking about this a lot on the program, given some of the strength that we saw over the past couple of weeks in EM. Of course, we saw that similar strength at the start of the year, and that kind of petered out. I'm wondering if this sort of surge that we've seen as of late is going to stick.
Timing is unknown for us. We are positioned as long-term investors. So we think the best thing that you can do as an investor is just buy very good businesses at very good prices. And so EM is offering those prices right now. We're buying utilities in Brazil. We're buying uranium and financials in Kazakhstan. We're buying telecom in South Korea, which, by the way, is more... It's not necessarily an emerging economy. It's priced as such, though, which is a great opportunity for us. So we look across the globe, and in the U.S., you're just not finding the same values as you could in emerging markets for the same sorts of companies.
Yeah, I mean, well put. And I am curious about the value proposition there. I mean, obviously anyone can look at the discount that you see with some of those names versus what you would pay to get a comparable company here in the U.S. But of course, we also know on a risk-adjusted basis, those two are not the same.
Absolutely. And we definitely take that into account. And so when we're buying a business in the US, we say maybe we need a 20% margin of safety, a 30% margin of safety, depending on the balance sheet and the type of industry it's in. If it's in an emerging market, we automatically take a 50% haircut. And then we're buying at huge discounts to even that risk-adjusted price. So we think that the risk that everyone is seeing is over discounted in emerging markets. And just as a reminder, people tend to focus on different parts of emerging markets at different times. In 2007 and 2011, all you wanted was to own the BRICS because they had the best growth and they had all these resources and the people. Now only people are thinking about the corruption and the difficulty to buy a business and the geopolitical risk. And so we think both are things that people need to think about. Yep. And right now, they're only thinking about the negatives.
So just put this into context for us. When you say you want to be looking into emerging markets, how does that compare to, say, the U.S. market or developed overseas markets? What portion of your portfolio should you allocate to EM?
It's really where the values are. So, and another thing is that emerging markets, people tend to think of it as a niche. But actually, it's 50% of the world's GDP. So if you're not investing in emerging markets, you're eliminating a huge percentage of the world's growth and economy from your opportunity set. So we think that as an active investor, you can really look and find the high quality investors or high quality companies and make sure that risk is actually mispriced.
Gotcha.
In some cases, the market is right, but we say maybe there's the pockets of inefficiency, and we're finding that in Korea Telecom, for example, is one of our largest holdings. South Korea is 19% of our portfolio, and it's classified as emerging, but it has GDP per capita, education levels, health levels of a domestic market, right. a development. And yet we're buying these businesses for half a book value and single-digit PE. So the value is really there. It's just you have to be, picky about which companies you want to buy.
All right, Elisa, really appreciate your joining us. Elisa Corcoran is Deputy Chief Investment Officer over at Kopernik Global Investors. We have some breaking news here. Five9 is set to weigh a sale 2 years after its failed Zoom deal. And we're looking at shares of Five9 turning positive, gaining as much as 5.7% at the moment. Five9 also likely to attract other strategic suitors, according to sources.
This is wild to me because, that deal fell apart. Well, it fell apart for two reasons. A, there was a regulatory scrutiny, which we keep talking about. But ultimately, it fell apart, too, because their share prices plunged, and then it just didn't really make sense, of course, to do a stock deal when you have that kind of thing. I'm curious as to sort of what they see now, because the prices really haven't recovered that much. And last time I checked, the regulatory environment here in 2023 isn't a whole lot different than where it was in 2021.
Yeah, well, maybe it goes back to the idea that perhaps something will change by next November. Yeah. Or by next year, this November.
All right, well, Five9 getting a strong bid out of this, and Zoom not.
Yeah, exactly. All right, we've got a lot more coming up on the close. We're just under an hour before we get to the close. We're going to get some insight on investing from Chris Ailman. He is the CIO of CalSTRS, which is the largest educator-only pension fund in the world.
And I spent my weekend in silver sequins to go see Beyonce, the Renaissance, the concert film. It truly is irreplaceable, taking over the box office top spot in its debut weekend. We're going to talk about how much money it actually made.
And you went to see the real thing, too, didn't you?
I did.
All right.
You should have seen what I wore that time.
I can't wait. The publisher of the Oxford English Dictionary has named its 2023 Word of the Year. It is described as a popular Gen Z slang term. We'll give you all the details on what it is. This is The Close on Bloomberg.
Just a little more than 43 minutes until we get to the closing bells here in New York. You look at the green on the screen behind me. You see a lot of financials, see a lot of industrial companies, but turn your attention to this board here and you'll see a lot of familiar names. In fact, all of the Magnificent Seven now down in the red, and it's a big part of the reason why you're seeing the broader market in the red. Well, at least for one part of the broader market, and that is the big caps tech stocks here. The S&P lower on the day, the NASDAQ lower on the day. but we're actually still seeing some bids coming into the Russell 2000 as well as into the S&P 400 mid-caps. That's despite the fact that you are seeing an uptick in yields here on this Monday afternoon, but you are seeing a downdraft in commodity prices, and the two sort of washing each other out as people are looking for both growth and value, and they are finding them in some of those names that have been long neglected in some of those secondary indexes like the Russell 2000. Of course, the big story today in the crypto space with Bitcoin around that 42,000 mark, and a lot of the names in that space, including Coinbase and MicroStrategy, getting a strong bid here on the day as well. Let's bring Abigail Doolittle into this conversation as we do every day at this time for our Options Insight segment. And Abigail, you're taking a deeper look into small caps and the outperformance that we continue to see relative to the broader market.
It's challenging not to notice, Romaine, because on the day we do have some weakness for the S&P 500, NASDAQ, and other indexes. The S&P 500 right now down about 0.7%, heading to its worst day in almost a month. But the Russell 2000 heading to a fourth up day right now at session highs, up about 0.8%. So this big question about whether or not Russell 2000 small cap can catch up to large cap. There's a greater than 10% spread. Let's ask that question to Chris Murphy, co-head derivative strategy over at Susquehanna. Great to have you with us as always, Chris. And is this that catch-up play? Will it actually happen? And does the S&P 500 need to decline or stay flattish for the Russell 2000 to narrow that gap?
Hey, Abigail. We have seen this, couple-day attempt for the small caps to bridge that huge gap with the larger cap stocks. We've seen that a number of times, but what's different this time is looking at the skew in the IWM. So really all that's telling you is the extreme demand for upside options, so upside calls, compared to less demand for downside puts compared to usual. When we're talking, 10-plus year highs in or lows really in IWM skew, how you measure it, or skew towards the call. So we've seen this attempt before that the options are really screaming that a lot of investors are aggressively looking for upside in the IWM. We really haven't seen that extreme amount in these last couple kind of attempts.
Interesting that it's happening with options and at the index level. Let's bring it over to the RVX versus the VIX, because of course the Russell 2000 does have a volatility measure, which is at 20. The VIX, of course, has a 13 handle, so a massive spread there. What does this tell you?
That's a great chart. And really the reason why the RVX hasn't come in is because those upside calls, the volatility there has remained pretty high. If you were to rewind to the summer, volatility in the puts downside is about the same. But the upside calls right now, the volatility is much higher there. So that's keeping that RVX higher. And we're going to keep that in mind when we're looking at option strategies in the IWM, because the volatility, especially on the upside, is not particularly cheap right now.
Not surprisingly, with this sort of a rally that's extended right out of November. Speaking of calls, you're seeing some folks sell calls on other spaces, other ETFs.
Yeah, November was obviously a great month for pretty much everything. And what we're seeing today is, we track big blocks of options that trade. We think there's a lot of information there. We saw call buyers in the XLF, which is the banks, and the IEF, which is the medium-term U.S. Treasuries, 7 to 10 year. We've been watching those trades. They were very successful in November, and now we're seeing them closed out here in December. So what that's telling you is, someone who has been doing their homework, who has had a good trade on, is deciding now. We think the rally in the medium-term U.S. Treasury bonds, as well as the rally in the banks, is due for a pause in December.
Well, great perspective right across the spectrum. And I know, of course, with payrolls coming up on Friday, some more volatility could be ahead. Chris Murphy, co-head of derivative strategy over at Susquehanna, thanks for joining us for Options Insight today. And from New York, this is Bloomberg.
So we've reported that Merriam-Webster's word of the year was or is authentic. Now the rival dictionary company Oxford has come out with its word of the year, and it is Riz, which is short for charisma, a colloquial noun defined by a person's style, charm, or overall attractiveness. When was the last time you used this in a sentence?
Well, I think last week when we were talking about it, also popping up on the other list there. But it gets to this idea of how do they choose these things, Scarlett? I mean, are they just sort of, they have their finger on the pulse?
I think they used AI and they checked people's social media postings.
Is that really? I mean, I don't know. I mean, I know I've heard it online, and people talk about it.
Your son probably uses it.
I don't know. He's smart. But I mean, so I just wonder, like, where they come up with this.
It's definitely making the rounds. It's probably on TikTok videos. Yeah. There's probably just, frequency that it comes up in. But, Gen Z, which uses this word a lot, is not to be trusted because I understand as well that Gen Z thinks that Nirvana is preppy clothing, like a Nirvana t-shirt. They see that as preppy clothing, which I don't quite understand.
Can I just tell you, this really vexes me every time I see young people wearing these shirts because I wonder, But then I feel like I did the same thing. Like when I was a kid, I would wear like Jimi Hendrix shirts just because I listened to Purple Haze once.
But you didn't think that it was preppy, though. That's the thing.
I'm sure whatever I thought, I'm sure it was wrong. So I try to give them a little bit of a break. But they got other words in here. Situationship, which is a romantic relationship that is not considered to be formal or established. Swifty, I think we all know what that's referring to.
That's its own economy. That's okay.
That's it. Also on the short list was de-influencing, heat dome, parasocial, and this one, beige flag, which is new to me.
Beige flag, what does that mean?
It's a character trait that indicates a partner or potential partner is boring.
Okay,
or lacks
not
originality.
A good term. So you don't want that reference to you in any way, shape, or form, in any kind of situationship, right?
No. I hope I'm a green flag for somebody.
Wow. Situationship, what was the other one after situationship?
I don't know. De-influencing, heat dome, parasocial. Take your day. Okay. Anyway, I doubt any of us are actually going to be using these words on any sort of a daily basis, but there you have it.
Bloomberg Television.
The Riz, that's your word of the year. What's the color of the year?
Color of the year, that's a good question. We have to get Pantone on to talk about that. But it's usually like what's been trending, right? Because they do look at what's been in the zeitgeist.
So this is backward-looking data.
It's backward-looking to reinforce what's happening.
Would the Fed trust it, Scarlett Fu?
They're data dependent, so it could change any day, any minute.
Looking at a bit of a sell-off, at least among the major averages here in the U.S. So Bitcoin getting its mojo back here on this Monday afternoon. Stick with us. A lot more coverage coming up here on The Close. This is the countdown to the close. Just about 30 minutes left to go here in the trading day. Interesting price action on this Monday, Scarlett, with the big cap names moving lower, small cap names moving higher.
They're outperforming, but let's start with the big caps here because this is the first decline in 3 days for the S&P 500. And you can see definitely the pie is more red, especially in those sectors that weigh pretty heavily. So looking to the downside, you've got communication services, that's Netflix, that's Alphabet, and you've got Infotech, each down by 1.5%. Materials also losing more than 1%. On the upside, it's kind of scattered around healthcare, real estate investment trusts, and staples. But you'd be hard pressed to say that these are really actually advancers. They're just not down as much and moderately higher for now.
I'm actually really intrigued by some of the rotation that we have been seeing, and maybe some of that is profit taking. You take a look at Nvidia, down 3% here on the day, but remember, it hit that record high of about $504, $505 just a couple of weeks ago here. So maybe the downdraft is really just some people taking some chips off the table, rather than any real change in the fundamental perception of these companies. Similar story for Microsoft, down a second day and now below that 20-day average here. But again, a phenomenal year for Microsoft, no matter how things shake out over the next 3 weeks or so. Meanwhile, travel stocks are getting a strong bid here on the day. There's no real news out there, but Norwegian Cruise sort of emblematic of that, up about 6% here on the day. Most of the other cruise lines, as well as a lot of the other airlines, also moving higher on the day as well. And keep an eye on 5-9, just crossing the Bloomberg terminal a little while ago. We're learning based on Bloomberg reporting that tie-up that it had back in 2021 where Zoom was going to buy 5-9, that deal was scuttled for a wide variety of reasons. We're now learning that deal could be back on, at least based on what our reporters have found out. Scarlett?
All right, let's put this all into context here and talk about the markets at large. Meb Faber is Chief Investment Officer over at Cambria Investment Management, and he joins us now. Meb, I want to pick up where Romain left off, which is on M&A. There's definitely a little bit of a pickup in deal making here. He mentioned Five9 and Zoom possibly being in play again. Of course, we heard about Alaska Airlines making a bid for Hawaiian Air, and we also see Swiss drug maker Roche paying as much as $3.1 billion for Carmot Therapeutics, which of course is behind one of the weight loss drugs. Is this something that can really get things going as a catalyst for different sectors that up until now may have been left behind a bit?
Yeah, if you look at the history of how companies use cash, there's only 5 things they can do with their cash, right? They can return it to shareholders through cash dividends or buybacks. They can do M&A, which tends to be value destroying over time for stock investors. They can pay down the debt if they have any, and they do what 99% of us focus on, the sexy stuff, which is reinvest in the business, build new products and services. M&A and buybacks tend to be quite a bit more volatile than things like investing in the business, but also mainly cash dividends. Part of that is just the cycle, right? CEOs tend to be a little bit, they see those as more capital expenditure type of initiatives, but on aggregate, particularly if you look at the buybacks, it's the CEO's job to allocate capital wherever they think they can get the highest return on investment. And that's not always reinvesting in the business. So often returning it, and when stocks are cheap, buying back stocks can be a much better use of money than trying to build out a new product, which is, as we all know, is really hard.
Right. Well, given that there is some M&A going on, what does this say about companies using their equity as currency? What does this say about valuations?
Well, we've for a while said we believe stock valuations are expensive. Although one of the things I've never heard anyone say, a commentator on TV ever, is they say investors are happy, they're complacent due to markets being low volatility, low volatile. Everyone always says investors are fearful because they're uncertain and markets are a lot of volatility. Right now, VIX has been cut in half this year. It's down in the low teens. You've had the stock market showing all that riz, like you guys were talking about, is up big this year, market cap weighted. But as we know, that's all backwards looking. You got this new opportunity where you can chill out in T-bills for 5%. But looking forward, what looks really great to us is moving away from market cap weight in the U.S., so small cap value, particularly shareholder yield, which is low valuations coupled with high dividends and high stock buybacks, and also the same thing abroad, particularly foreign developed and emerging markets. The broad market cap are cheaper, but the shareholder yield there, across all three, you're looking at single-digit PE ratios, a little bit different distribution as far as the cash and dividends and buybacks. Countries over there across borders tend to buy back less stock than the U.S. does. Yeah. But on average, you can get low double-digit shareholder yields.
Well, I am curious when we talk about the valuation gap, and a lot of people have pointed that out, particularly with U.S. and non-U.S., but even within the U.S., within the S&P itself, and to see the valuation gaps there, which have really blown out, not quite at the extremes that we saw, I think, back in the late 90s, early 2000s, but certainly something to be had. But why am I to believe that valuation gap closes because of a rally for those beaten down names rather than a loss on those names that have rallied so hard?
I mean, it may not. There was a period a couple of years ago, February 21, where I thought we were going to break out to the highest valuation we've ever seen in markets. Didn't quite happen. On a 10-year P ratio, we got to about 40, where the peak in 99 was 45. But look, I think you and I were talking about this summer on the roof here in LA. I think valuation is a blunt tool. It plays out over time frames of years, if not decades. Most investors want time frame of hours, weeks, months, even then. But that having been said, small cap value has had a good year. It's just not as good as the big market cap, Magnificent Seven, whatever we're calling them today. Mm-hmm. But value in foreign has also had a good year. I think as we look back at the fullness of history, we're doing this interview in 2025, 2030. We're going to say the inflection point was 2020, 2021 for value stocks, and the outperformance lasts the better part of this decade. unfortunately, we'll have to wait 2, 3, 4, 5 years to see if this plays out. But the spread is some of the highest it's ever been, and it is a massive opportunity both within the U.S. and ex-U.S.
And we've certainly seen investor sentiment shift. I mean, when you kind of look at least on the terminal, Bloomberg terminal, at some of the factors that have performed well this year, you definitely saw obviously growth and momentum do well earlier this year and even into the middle of the year. But really over the last couple of months, you've really been talking a lot more about dividends, value, and some of the other things, I guess, that would kind of fall under that broader value umbrella here. What sustains that, though, in the short term? I know longer term, they'll probably win out. But in the short term, is there something to hope for there?
Yeah, sentiment follows price, which is when you have something that's down 60, 80%, nobody cares, even if it moves a little bit or even if it moves a lot. No one here is pounding the table for Chinese stocks. No one is clamoring for Italian stocks, saying, Mamma mia, these are up. They're beating U.S. stocks this year. Brazil's beating U.S. this year. But what happens is after a sustained period, I mean, look at gold right now. A lot of chatter about gold at all-time highs. All of a sudden, if gold hits 2,100, 2,500, 3,000, then you'll start to see a lot more interest and enthusiasm. My favorite investing personally is the combination of value, so something that's cheap and hated, and in an uptrend. So that combination of cheap and an uptrend, and that is right now, it's both U.S. small cap, it's also foreign and emerging. The U.S. large cap is expensive in an uptrend, which is not a bad place to be. Again, going back to low volatility, people chill, but better going forward, I think, are the cheap ones.
Yeah, but the key word there is that everything's in an uptrend. What about the dollar? Because with expectations that the Fed, whether you agree with it or not, is going to cut rates next year, the dollar is seen weakening in 2024. How much is that going to be a tailwind for the big multinationals, the big caps, essentially?
I'm going to need the U.S. dollar to stay high for about 2 more months. I'm going skiing on my annual trip to Japan, and so the yen is up, around 150. After that, it can fall apart. But being serious, look, U.S. dollar, there's no question it's expensive on a purchasing power parity basis, particularly against Japan, but against a lot of different pairs. But again, if you look at currency factors, much like U.S. stock market factors, you have the various forces. You have value, so purchasing power, you have trend and momentum, yield curve, and the big one being carry, of course. As those shift, I think you could see, again, looking back, the U.S. dollar perhaps have peaked in this cycle in the last year or two, but who knows? Over time, real currency rates tend to be very stable, the key word being over time.
Yeah. Matt Faber, you're going to Niseko?
Niseko, all over Hokkaido. You guys want to do a meetup in Japan? We'll take you around.
All right, we'll look into that. We're on it. Matt, thank you so much for joining us. Matt Faber of Cambria Investment Management. Coming up, we've got the top 3, our new segment where we focus on the top 3 movers and shakers at the center of the day's biggest stories. This is The Close on Bloomberg. It's time now for the top 3. Every day at this time, we do a deep dive into the people at the center of today's top stories. Romain, who are you keeping an eye on?
Well, I've been keeping an eye on Mark Zuckerberg because he's been up to a little bit here. I don't know if you've noticed that the shares have had a pretty good run this year in Meta, second best performer, only to NVIDIA, and I guess, taking chips off the table. We're learning that Zuckerberg has actually sold about 682,000 shares. That's roughly worth about $185 million. That was in November, and we should point out this was through kind of these sort of pre-planned trading programs, so it wasn't like he was actively trading or anything here. But it also gets to the idea here as to when someone with his wealth and his resources decides, maybe I just need a few extra bucks in my account. What's the thought process behind that? I'm assuming $185 million. I'm just waiting for the announcement in a couple months from now that he bought like a $180 million yacht.
Yeah, that sounds about right? Yeah. Making a big investment.
That's what they always spend it on, right? I mean, what else can he do? He can spend on a rocket ship.
Well, we know he gets a mortgage because he got a really low mortgage from First Republic for his house. I'm watching Richard Branson, who told the Financial Times that he doesn't plan to make any further investments in his Virgin Galactic startup. He said his business empire doesn't have, quote, the deepest pockets following the pandemic. And he believes Virgin Galactic should have enough funds to do its job, which is to send people into space.
I'm very confused by this because I saw this headline over the weekend, and it gets to the idea. I mean, he's not really throwing in the towel on this, but he's kind of making the case that I guess this business is going to have to be self-sufficient.
Yeah.
Or I guess get money from other people, but just not out of his
Just
pocket.
not out of him.
Yeah.
Yeah, well, analysts say they never assumed any further injection from Branson, but he did serve kind of as an implicit source of liquidity support. So maybe that's removed. You take a look at Virgin Galactic, investors see this as bad news because it's down on the day. It's one of the worst performers in the Russell.
Yeah, I think it's more the optics. It's kind of like, what's the commitment behind this? Is there going to be more money behind this, or is this him walking away? There's a lot we don't know, but like I said, when you kind of put those statements out there, it leaves investors to kind of read it.
Watching billionaires and what they do with their money.
Absolutely. You know what I was watching this weekend?
I know.
Beyonce had this concert movie. I don't know if you heard. It's a big deal. She had a big concert over the summer, wind it down, and now she released her theatrical film. Had a good weekend, about $21 million in the box office here. That was actually the #1 movie at the box office, beating out Godzilla. I didn't know there was a Godzilla movie for that matter, and a Hunger Games movie, which I also didn't know existed.
Did you dance in the theaters when you went to go see this?
No, actually, and I'm being a little facetious. I did not actually go see this in the theater. I did
you
see
saw the real thing.
I did see her in person, but I did not go to the theater. My wife is making a pilgrimage to this thing later this week with her girlfriends to go see this, and it's a big event. And look, concert films is kind of keeping AMC afloat. Remember, you had the Taylor Swift concert film, which did phenomenal.
Yeah, so this is the next one in that category. It's a new thing.
All right, stick with us. A lot more to cover here on The Close. This is Bloomberg. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. We're looking at a market in which stocks are down, bonds are down, the dollar is higher. It's a bit of a reversal from the everything rally that had been underpinned by the expectation that the Federal Reserve will cut interest rates next year, multiple times next year, in fact. So it's a bit of a reversal there. But what has persisted, Romaine, is the Russell 2000 outperforming small caps seemingly in favor these days.
And this also is playing out in the S&P. I mean, it is down on the day, but about half the stocks are higher. And when you look at the names that are higher, well, obviously they're larger cap in nature, they just certainly sort of skew a little bit more towards that mid and small cap flavor. And it gets to this whole idea of what we were talking about with Meb Faber, this idea that there is such a huge valuation discount out there, both internally here in the U.S., but U.S. versus rest of the world. For a lot of people, it's just too much to ignore.
Right. I mean, they had been ignoring it for a while, but maybe now you make up some lost ground.
All right, let's get some insights out of our next guest as we count you down to those closing bells. Just about 9 minutes until we get there. Christopher Ailman, fresh off a plane from California, joining us right now. He is the CIO over at CalSTRS. Of course, this is the largest educator-only pension fund out there, more than $300 billion in assets under management.
318.
I don't want to shortchange you.
No, 318 today.
Chris, great to have you here in person in studio, too.
Thank you. It's always nice to be here.
I'm not sure if you brought the cyclical trade with you, but I'm curious as to whether you think there's some legs to it, because we've seen kind of the Russell, the small cap, S&P small caps outperform on a daily basis and a weekly basis pretty frequently over the last few weeks, and I'm curious as to whether you think there's more behind it.
This is the soft landing. It's okay. Finally, we're getting rid of just the Magnificent Seven, and we need that breadth. You need the small cap to come up and actually do a little bit better. GDP isn't negative, so the market's going to be okay. I don't know if the Fed is going to ease very quickly in 24. We have to readjust to that. November, people got ahead of themselves, but I think that we're going to see rates flatten out. We're at the top. Going to slide down a little bit, and that's good earnings for small cap.
Well, I want to follow up on that, and with the big asterisk that you are kind of the longest of long-term investors. But when you look at the price moves and the correlation that appears to be out there for Fed cuts, multiple Fed cuts next year here, do you think the market is getting maybe a little bit too ahead of itself?
Well, Romaine, I'm big macro. Big macro. So, yes, the market is ahead of itself. I think that realistically, the Fed may start to gradually ease, but not till they get a lot of inflation reports that are benign. They need inflation to be at the threes. They're going to watch employment. We all know that. They're data driven. And so they'll worry about employment, but they're not going to rush into this, and they don't need to back off. They achieved the soft landing, believe it or not. So now they could just glide down the runway. Low GDP, but you know, a nice earnings environment, the market's going to do okay. Look where we are fiscal year to date or calendar year to date for the rest of the world, in U.S. and non-U.S. stocks are doing okay.
Yeah. So what happens to the trillions that are sitting in money market funds, waiting to go into something as soon as the yield on those money market funds comes down a little bit? What's going to prompt them to take a big bet in some of the cyclical plays that we just talked about, or maybe the rest of the world?
I feel that personally. I'm not in the trillions, but yeah, a lot of money sitting on the sidelines. Not for our fund. We've been fully invested in this market. I've been predicting a recession for 16 months, Scarlett, and been wrong the whole time. So I don't know. People are waiting for downturns. I think you'll see continued buying on the dips. But it was, frankly, the time to buy was back in October when we sold off. I'm a little worried that, frankly, if you look at a chart, we've had a double top as of today. So that's technical. Doesn't immediately mean that we're due for a down market. But people are going to buy on dips, and I think they should look at the asset allocation and stay invested.
I'm just curious, though, too. I mean, I'm just looking at your most recent asset allocations, and you are over your target on cash right now here. I assume that's more short-term tactical?
It is, and it has to do with liquidity.
Okay.
Private markets have not repriced. Private equity has not really opened up. Today was a little bit of a merger Monday with Alaska and Hawaiian Air, but we really need to see private equity open up. I'm worried about drawdowns in capital, so we want liquidity.
What counts as having a contrarian view in this market?
Probably the fact that you think there's a recession and it's coming. I think the contrarian view is, frankly, the soft landing, that they achieved it. Markets are always overextending one way or the other. Right now, they thought way too many rate cuts. I know somebody even predicted a rate cut in the first quarter.
Yeah.
Bill
That's crazy.
Yeah,
Bill. Well, I'm not going to argue with him, but he's got billions.
I'll argue with him.
Okay.
Not
you
public.
take him on. You take him on. But it's, it's a kind of market where it is tough to get too far ahead. Earnings are really low. They're positive, but they're low. And the economy is very slow. The consumer's spending at Christmas, which is good, but they're unhappy about prices being up.
On the earnings front, though, were you surprised at the resiliency in some of the earnings this year?
Completely surprised. It really has blown me away. And the stock reaction has been very muted. I mean, obviously, other than the big seven, you take them out of the market's doing nothing in the USA. We are trading sideways, which might be the contrarian view of the soft landing. It's just more of the same, mudding along, trying to get through. If 2004 repeats 2003, I don't think investors won't be real excited about it. Single-digit returns, low returns in equities, but that's like the old days. That's what you should get out of stocks with rates at 5.
How are you looking at the rest of the world, the emerging markets, for instance, the developed world? We've been talking to a lot of people who are saying now's the time to go into emerging markets. It's the attractive bet in the same way that small caps are attractive.
Well, they're out of favor, and emerging markets have been out of favor for 2 years now. It's the fact that non-U.S. has done quite well. Everybody's really surprised at prices in Europe having been up 10% this year. And Europe is much more balanced than the USA. Or the U.S. is the Magnificent Seven. Europe's got a bunch of things, a bunch of companies doing well.
I'd be remiss in letting you go, Chris, without getting your thoughts here on what's going on in the real estate market. Obviously, I know CalSTRS has a big real estate position, and there was a lot of gloom and doom coming into this year about the collapse of commercial real estate. That hasn't quite happened. Doesn't necessarily mean it's going to happen. What do you think?
I remember coming on the Close, your show, probably back in March, and saying real estate office needs to drop down 20%. Made a few headlines and then went away. What we're seeing is a slow grind lower. Is office market is dropping about 5% per quarter, probably going on now 4 quarters. So real estate is still very bottled up. Not a lot of transactions. They haven't readjusted to the higher rates.
Is it better to have that slow burn down, or would you prefer just a collapse? So
I'm used to real prices like we see on the screen, so I'm used to things readjusting quickly.
Ripping off the Band-Aid.
This is just, the lack of transactions means there's no prices for appraisers. I get it. But hey, when rates go up 500 basis points, you have to readjust, and they're just not doing it. But slow market, and we're going to see if it opens up, but I don't even know what will be the catalyst to open it up next year.
All right, Chris, always wonderful to talk to you and great to see you in person. If we don't see you before the end of the year, have a Merry Christmas. Chris Ailman there over at CalSTRS leads that team there as the Chief Investment Officer. As we count you down to the closing bells, just about 2 minutes until we get there with the S&P and the NASDAQ on the back foot, the Russell 2000 and small mid caps right now moving higher on the day. Stick with us. We're about to take you to the bell and beyond.
Beyond the Bell Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast. We're joined once again by Tim Stenovic and his sidekick, Carol Masser. Welcome to our audiences across our Bloomberg platform, television, radio, as well as those folks streaming us on YouTube.
Sidekick. I'm honored to be his sidekick. What do you want? You know, it's kind of an interesting day, right? A little bit of a break from some of the enthusiasm that we've seen. Although I'm looking at equities, I'm looking at the S&P maybe at its best levels of the day. Having said that, did you guys see what's going on with Bitcoin?
Yes. Yeah, on fire.
Unbelievable. Hitting 42,000, right? The last time we saw that was what, April of 2022, I think. And it's up about 152% year to date. I mean, crypto, still not, Bitcoin specifically at its highs that we've seen, but definitely quite a bounce back.
There's kind of some weird mixed signals happening here. Like there's the euphoria of crypto with Bitcoin hitting a high that it hasn't seen in months, Scarlett. There's also gold moving, higher and also lower on the day today.
Safe havens, both of them, safe havens.
But it's kind of strange given the way that people are talking about, the relative strength of the economy, what we've seen in the equity market over the last 5 weeks, and what they expect the Fed to do. 1,000,
right? The last time we saw that was what, April of 2022, I think. And it's up about 152% year to date. I mean, crypto, still not, Bitcoin specifically at its highs that we've seen, but definitely quite a bounce back.
There's kind of some weird mixed signals happening here. Like there's the euphoria of crypto with Bitcoin hitting a high that it hasn't seen in months, Scarlett. There's also gold moving, higher and also lower on the day today.
Safe havens, both of them, safe havens.
But it's kind of strange given the way that people are talking about, the relative strength of the economy, what we've seen in the equity market over the last 5 weeks, and what they expect the Fed to do early next year.
And then you've got the Russell 2000 continuing its outperformance. I'm just looking at volume, and yes, volume is higher for the big caps, but it's much, much higher for the Russell 2000, 28% above the 20-day average. Volume in the NASDAQ 100, for instance, about 50% above the 20-day average, but it's to the downside.
Yeah, and in which you point out, this is 4 straight days where we've had outperformance of the Russell versus the broader markets. And I was taking a look at the differential between that and the NASDAQ 100 here at 1, 2, 3, 4, 5. This is something like the 6th best outperformance of the year. I'll double check that number here, but this is a meaningful outperformance, not just something willy-nilly here. You take a look at the numbers on your screen, right across the 3 biggest averages here in the U.S. with the Dow down 0.1%, the S&P down 0.5%, and the NASDAQ composite down 0.8%. But you switch that camera around and take a look at the Russell 2000, 19 points higher. That's about 1% here on the day. We saw similar moves on the S&P 400 mid caps and a slightly smaller move, but still to the upside on Dow transport.
All right, since we're spending so much time on the Russell, so let's go there. You've got 1,416 names in the Russell 2000 higher today, 511 to the downside, 40 unchanged. So you do see increasingly, Scarlett,
investors. Did you count those individually by yourself?
I did. Fingers and toes.
She uses the Bloomberg to great effect. All right, let's take a look at the sector performances. You mentioned the Dow transports remain. You can see transportation stocks at the top of the pile. They're gaining 0.7%. The exception there is Alaska Air, Real Estate Investment Trust, and Consumer Durable and Apparel also gaining about 0.5%. On the downside, that's where you've got the big tech names. Chip companies, media and entertainment, that's Netflix, that's Alphabet, and software and services all down by at least 1.33%.
All right, guys, individual gainers. Speaking of the Russell 2000, the top gainer in the Russell 2000 is Hawaiian Holdings. Shares soaring up 192%. We all know the story. Alaska Air agreeing to buy the company $1.9 billion. It's a cash and debt deal, and there is some investor concern about regulatory hurdles. We just talked with our George Ferguson, though. He doesn't necessarily see it, so we'll see ultimately if this deal gets done. Got to mention Spotify up about 7.5%, finishing off its best levels of the session, but nothing like job cuts to get a stock soaring. Looking to cut about 1,500 jobs. That works out to about 17% of the company's workforce. It's the company's steepest cuts yet this year. They're looking to cut back on their costs and also drive some profitability. So again, Spotify, an outperformer, up 7.5%. Beyond, it is the newly renamed Bed Bath & Beyond.
Yeah, this is very confusing. Because when I saw this ticker last week, and I thought it was Beyond Meat.
I did too.
And then I forgot that Overstock completely rebranded it.
Throwing some plant-based stuff on the
barbecue. Maybe they should combine.
Maybe. Yeah, get some towels and get some Meat. There you go. Beyond, you might remember. I don't even know. I know.
It's plant-based.
All right, it's plant-based stuff. Yeah, it was late October that they officially changed the company name to Beyond. November 6th, remember, CEO was stepping down at the request of the board. That's never great. And then November 29th, headlines about the new board co-chairs and how company leadership mandated an intense restructuring, and it had begun taking decisive actions to do so. Nonetheless, this company, they announced record sales performance for the Cyber 5 holiday period, details of a restructuring plan. Stock is up for its 7th straight day. It has gained nearly 40% since November 22nd, so quite an outperformer. This one, too, it's a small cap biotech. There's lots going on in biotech. Tech continues to be so. EyePoint Pharmaceuticals more than doubling in today's session. Check it out, everybody. Up 177%, jumping the most in about 19 years. Heavy volume, saying its mid-stage trial of its investigative therapy for eye diseases met all primary and secondary endpoints. Cantor calls the data a home run. And honorable mention, I don't know if we're going to bring it up, but Uber Technologies up. It's going to be added to the S&P 500 on December 18th. So
wow. A lot of gainers on a day
lot
when,
of stuff to choose from.
We saw a lot of red on the major indices. No, I only have 3.
4 and an honorable mention.
I'm not what you call an overachiever, okay? Let's go to the decliners. I do want to start with Alaska Airlines Group. It's the worst performer on a percentage basis in the S&P 500, closing down on more than 14%. We know the news today. Alaska agreed to buy Hawaii Holdings for $1.9 billion in cash and debt. As Carol mentioned, we did get to speak to George Ferguson over at Bloomberg Intelligence a little earlier. He's kind of a head scratcher in terms of what Alaska gets, although he did add that it gets some connectivity inter-island when it buys the rival. And then also it increases Alaska's international routes with connections to Asia. But at the same time, it also gets challenges that Hawaiian Airlines has faced. Engines of some of the planes have to be removed for servicing, which takes the planes out of rotation, and more. Also wanted to get to shares of NVIDIA, among the worst performers on a points basis in the S&P 500 today, down 2.7%. Not a ton of news. I mean, the stock is up more than 200% so far this year. But we did learn that NVIDIA executives and directors sold or filed paperwork showing that they intend to sell about $180 million worth of stock. If all the shares were sold, Romain, it would be the biggest monthly disposal by dollar value this is in 6 years, this according to the Washington service. And then finally, just an honorable mention for Starbucks. Shares down for an 11th day in a row here. Ooh. Look at this. 1.6% as a decline. Longest losing streak since the 1992 IPO. It's fallen 9%.
So I looked into this because I saw last week, I was looking at that streak, and there was no news, but it does appear to be some analysts have come out and said they have some concerns about a slowdown in growth.
Yeah, cooling sales is what I saw.
Cooling sales, and they mentioned like alternative data. So who knows whether it's real or not, but certainly investors are kind of bailing on it.
It's a momentum trade at this point.
Yeah. Interesting too, kind of investors, at least for one day, bailing on that Treasury rally where we saw prices actually move higher, which pushed yields down pretty significantly over the past couple of weeks. That's put on pause here for this day in a pretty big way. A significant sell-off that we saw today that pushed yields higher on the 2-year yield up by about 9 basis points, and a similar move on the 5-year. On the longer end of the curve, not so dramatic, but it really is kind of the setup heading into this week, a week where we're going to get a lot of economic data that may potentially ratify a lot of these bets on rate cuts heading into 2024, or maybe it throws cold water on those rate cut bets.
Maybe people are closing out the positions to bid up Bitcoin. Who knows? Pushing it above 40,000, 41,000, 42,000. Not sure where it goes next from here, but it definitely, there's a FOMO, stain on it.
I thought what was interesting is Mike McKee, I think, was on with maybe you guys on television earlier, and just talking about specifically how we're finally going to start getting November data, right? So it's a little bit more relevant to this quarter, certainly, and trying to give us an idea of just maybe some forward-looking trends, if you will. But all of this jobs data, it'll be interesting to see what jolts. I think he said it was still going to be up near that 9 million mark, so still kind of showing some strength. But whether or not what we get on Friday ultimately shows that we continue to see some softness in the labor market and some softening data, not necessarily falling off a cliff.
You guys are speaking to Katie Kaminsky a little later on the program, right?
Yes.
Will you do me a favor and ask her if she's sticking to that 6% call in the 10-year? She was early to that, on our program months ago. And, we hit 5%.
Yeah.
But a lot of analysts are saying, okay, well, we kind of hit peak rates, at least on the 10-year.
Yeah, it seems to be the narrative, but I guess it gets to this idea, and I'm glad you bring up the November data, I mean, or at least Mike McKee brought it up, because it gets to this idea, too, that when everyone saw that momentum coming out of the third quarter into September, there was this idea that, okay, you have to have a drop-off in November. So I guess the question is, are we going to start to see that in some of the data that we got this week? Or if it does show resiliency here, does that then add fuel to this fire that, yeah, maybe that soft landing is in the cards? We spoke with Chris. I know you keep tabs, Tim, on all of our guests, but we spoke with Chris Ailman just a little while ago. He's kind of in that soft landing camp right now as well.
But there's also the alternative of that, which is if we do see strength and resiliency, does it mean that the Fed has more work to do to actually bring the economy to a place where it does cool down?
I feel like the Fed is kicking up its heels right now and basically saying, hey, the market's doing all our work for us. But maybe it gets back to the idea, too, and I know we're going to have this conversation ad nauseum next year about the transitory nature of some of the inflationary pressures and whether they truly were transitory this whole time and whether what the Fed actually did had any real material impact in bringing that down.
I also do wonder as things come down, right? They always say it's much more difficult, right, when in terms of those last few stages of getting inflation down. But I also do wonder when things start to kind of come undone, how quickly it starts to come undone and kind of plummet, whether it's economic growth or so on. So I guess I still feel like we're coming out of the pandemic. We don't quite know. I mean, could it possibly be that we get this very soft landing?
Out of the pandemic?
Well, there's a lot of one-offs.
But I still feel like there's still a lot of money sloshing around in terms of infrastructure spending and some of the bills that came out of Congress. So I just do wonder, I don't know.
You know, I was looking at the Atlanta Fed GDP now. It's now forecasting 1.186%. That was from, what, a 5 handle in the third quarter?
So, well, we'll get those economic projections.
But what was it at the start of the year? It was like negative, right? I mean, you know, everyone's like, oh, I mean, 2% growth for the U.S. economy, that's good, right?
It's better than
it's just that dramatic slowdown
2%.
you're talking about.
Yeah, exactly. I mean, I know people want to parse every little thing, but anything else, Carol?
This
I think we have to go.
This sidekick has to go. All right, we will see you tomorrow. That'll do for our cross-platform coverage. Radio
Are you both going to be here tomorrow?
Yeah, we'll both be here. Don't worry. We'll be here.
Oh, man. Radio, TV, YouTube, Bloomberg Originals, Beyond the Bell. Folks, we will see you tomorrow.
And as Tim Stenovic just promised, we continue our coverage here on Bloomberg Television with Katie Kaminsky, Chief Research Strategist over at Alpha Simplex. That conversation coming up here on The Close. This is Bloomberg. A down day for the major indices here in the U.S. with the S&P, the NASDAQ, and the Dow moving lower. Though we should point out that we did see a bump up in some of those cyclical names, particularly with the Russell 2000 and the S&P 400 mid-caps. But you take a look at the latest CFTC data positioning behind me, and quite frankly, this is an interesting story. Those red lines on your screen, those are the net shorts on the S&P 500. Those net shorts, with the exception of 1 week this year, have been in the red. No real conviction behind this rally, despite the fact that everyone right now, assuming you rode this from the start to the finish, is sitting on double-digit gains. So what comes next? Is it going to be the S&P? Is it going to be semiconductors? Or is it going to be that cyclical trade, that value trade that a lot of people said really should have gotten its due several months ago? Maybe it's finally starting to get its due right now. Dow Transport's up about 0.4% here on the day. Now, whether that's related to the move that we saw up in yields, well, that remains to be seen. What most people do seem to agree on, though, is that the Fed is done. That at least is what the market is pricing in, and they're doing it in a very aggressive way. You're seeing that play out in the SOFR market, in the options market, in the bond market as well, and you're also seeing that play out in some of the inflation hedges. The yin-yang right now between Bitcoin and gold, which one offers the better hedge? Well, as of right now, seems like both. Everyone seems to be piling into both, with Bitcoin staging a phenomenal rally, up 150% on the year, and gold, while down on the day at one point here intraday, it did actually top its all-time high. So there is a momentum trend here going back into these names, and that's pretty much a function of the ability, or at least I should say the perception, that the Fed is now out of the picture. Now, Wall Street did kick off the week with losses. Both stocks and bonds are down, and that's raising the questions that a lot of traders have. Traders' expectations of Fed rate cuts, are those expectations just maybe a little bit too optimistic? Katie Kaminsky joining us right now, Group Chief Research Strategist over at Alpha Simplex. And I'll pose that question directly to you, Katie. You've seen the numbers here. We're talking about 4 to 5 rate cuts priced into this market for 2024. You justify that?
I'd have to say that I think we were very quick to jump to cuts right away. I do think cuts are possibly on the horizon soon, but I think people are very optimistic to have that happen sooner than later. And so from my perspective, I think we still need to parse out this trade a little bit more. It has been almost 2 years of a short bond trade, and we have started to see that dissipate. We're starting to see trend signals move short against fixed income after so long. And we've discussed it a lot, but I think we really need to figure out the data. We need to see more evidence before we move forward.
I am curious, Katie, about this idea of where bonds are going next. I mean, we talked about, of course, the big rally that we had over the last few weeks, obviously a bit of a breather today, but it gets to the question as to whether we truly did and see the peak in rates, even if they don't necessarily come down by a huge amount, that basically high fours at 5% levels that we saw on the short end, whether that was it.
Well, I'd have to say it does feel like that right now in the market. But one thing I want to caution is that these particular moves, we've been watching 3 phases for fixed income. We started with an inverted yield curve. We saw a disinversion. And the next phase of that, we think, and typically historically, is a steepener. So the question we're asking now is, what is that steepener? Is the steepener going to come from us getting cuts where we actually see the yield curve move and then sort of have get that steepener, or are we going to see a little bit more turbulence before we get to that point? I think that's really, as a technical trader, those are the signals I'm looking for, the next phase of the bond trade.
Katie, you spoke with our radio colleagues, Carol Massar and Tim Stenovic, back in August, and at the time, it was a very different environment. They asked how high 10-year Treasury yields could go, and you had actually said 6%, why not? Is that possibility still there?
I think that 6% is going to require some sort of deflationary move in bonds. And that would require something that people are not really worried about right now. But this is always a worry through this type of cycle. So when I'm talking about a steepener, I'm talking about a credit event or an excess supply event where you actually see that yields have to steepen on the long end, even in an environment where we see cuts. Mm-hmm. So I think that's really sort of a very, very rare scenario. But when we think about this from a technical perspective, we try to think about what are the difficult scenarios that we might not be thinking about. And for me, that's really a scenario where bonds have trouble because there's too much supply, or that we sort of go through a difficult economic conditions without sort of the demand for fixed income that we had previously.
It's been a couple of months since we talked a lot about risk premium, the need to build more of that into longer dated treasuries, the excess supply that the U.S. Treasury Department was going to introduce to the market. How big of a threat is that going to be in 2024?
Well, that's going to be the question. And that's where you're asking where that challenge is that people aren't talking about. I think the challenge is corporate debt rollover. It's credit events that cause us to go through cycles of boom and bust where we see sort of challenges to risk assets. I think what people are underestimating right now is that the world has changed. We've moved out of a period of moderation to a period with higher volatility and growth. You just mentioned it recently on the program here, and also higher volatility and inflation. And so with more volatility, we're going to have more cycles in risk assets, and we need to think about that.
I want to get your thoughts, Katie, though, on some of the moves that we've been seeing in the commodities space and whether we should sort of buy into some of the, historical correlations that you would normally apply when you see commodity prices soften like that, or, for lack of a better phrase, is this time different?
Well, I think what's concerned me lately is those commodity prices really coming off is a little bit of a leading indicator that the weakness isn't great. And that's what makes me nervous about the recent rally in equities. It's just this idea that weak is good. The problem is going to be, when is weak too weak? And that's what we have to start thinking about. So as you see demand dissipating in the energy markets, you have to start wondering, when does that narrative converge into other asset classes? So I think commodities, they really don't look like there's a lot of momentum on the upside right now. And that suggests that there is a little bit concern for growth going forward. And we need to watch how fixed income and equities move as a result of that later.
Katie, as we wrap up our conversation, what would you say is the most contrarian view of the market right now? What counts as being contrarian at this point?
Ooh, That's a good question. It feels like everybody's moving the same direction. I mean, there's been this huge risk-on rally that has moved in such strength that it makes you wonder how much overshoot there is. So I think anybody who's considering that with a little bit of skepticism is a little bit contrarian, but might actually be right over a longer term. So I think contrarian is not jumping on the bandwagon too quickly.
Not buying into the everything rally at the moment. Katie, really appreciate your joining us. Katie Kaminsky of Alpha Simplex. Coming up, Harvard and the other Ivy schools are battling reputational risks as anti-Semitism rises on campuses, and now alumni are rethinking their donations, trimming them, in fact. This is The Close on Bloomberg. Let's turn now to one of the day's most read stories on the Bloomberg terminal. The presidents of Harvard, Penn, and MIT will testify tomorrow before the Congressional Committee on Education. This amid a rise in anti-Semitism on campuses. Let's bring in now Janet Lauren, Bloomberg's higher education reporter. And Janet, of course, this happens at the same time that alumni are pulling back on their donations. We just showed a promotion about how the surveillance team will be visiting Apollo's CEO, Mark Rowan, one of the most vocal benefactors out there, to say that he's not donating to Penn because of what's been happening and how the colleges have managed that. How are you looking ahead to tomorrow?
Well, tomorrow you're going to see Congress asking tough questions about why continued protests, why continued behavior is allowed on these college campuses. Is it really free speech if it's hate speech, if it's slogans with bullhorns, disrupting classes? And I think the idea of disrupting classes and not being able to get an education is a big concern of Congress. And you put that with what's going on behind the scenes with alumni who are pulling back on efforts big and small, in addition to not donating, people who are making the phone calls, sending the letters to their classmates, doing alumni interviews, saying, I don't want to do this anymore, I cannot endorse Harvard. We have a comment in the story from an alumnus affiliation for over 30 years saying, I am no longer proud to be an alum of Harvard, I'm embarrassed.
Well, this gets to the idea. I mean, let's set aside the dog and pony show that's going to happen on Capitol Hill. I'm sure there'll be a lot of misinformation. But how do you sort of woo back some of those folks who do feel disillusioned? They feel like, hey, I went there, I've given you all this money, and now I feel like the environment that you're fostering there isn't necessarily compatible with my worldview. What can those administrators do? What can those presidents do?
Yeah, it's a very good question. Yeah. When you hear reports about things that are going on campus, and as I said, students don't want to go to classes, I think people envision what it was like for them, and to have that feeling that they're not in an environment where they're learning, or they can envision their kids there. It's going to take a long time, because Harvard has built up these networks over decades, and people have used the same word. They feel very betrayed by what's going on. And as people, we had an example of somebody who has changed his will and has talked about it. You know, Harvard gets donations, bequests in, and it's not just about reputation and money. It's, you know, it's you just don't hear this about Harvard in the way you've been hearing it over the last few months.
Whether we like it or not, there's going to be a dog and pony show, as Romaine referenced, and the presidents that will appear before Congress, notably, are all women. Claudine Gay of Harvard, Liz McGill of Penn, and Sally Kornbluth of MIT. They're also all relatively new to the job as well, aren't they?
Yes, that is true. We saw a string of people retiring after COVID. You know, these jobs are not easy in the best of times, let alone the worst of times. So a slew of people had retired, and all these people are relatively new in the job, less than a year. Claudine Gay started July 1st, a few days after the Supreme Court had a ruling that said Harvard and other schools could no longer use race in admission. So it's been not an easy time.
Not an easy time, and this now gets to the question, how do they go back and deal with this? There's a free speech issue. There's also the whole perception that college campuses are supposed to be kind of this hive of competing ideas, even if some of those ideas might not be palatable. When I was in school, we had the same issues. You would have certain speakers show up that clearly had, at least in my view, some reprehensible views, but they were allowed to speak, not without protest, but they were still allowed to speak here. Is the net result of all this is that we're going to have maybe a little bit less discourse?
I think universities typically want to have positive discourse. You know, you haven't heard Dartmouth, for example, be as heavily criticized because they sort of came out in front and had a lot of professors speaking about it. I think the criticism is more that it's continued hate speech, and it's not this discourse that I think universities are famous for fostering. So it will be interesting to see how this all plays out.
In the meantime, fundraising is a big issue. How are the schools responding to that quickly here?
Well, we had another little item in our story that Harvard Business School is delaying the peer-to-peer solicitations. Usually people write letters, Harvard Business School will send them out, and they're pushing those back because they don't want people to say, no, we don't want to do this, and very smartly are postponing those decisions, whether or not to have these peer-to-peer letters come out.
All right, Janet Lauren with Bloomberg News. Stick with us. A lot more coming up, including a closer look here at some of the energy deals that could actually happen in the final stretch of the year. That conversation coming up next. This is Bloomberg. A bit of a pullback in U.S. equities on this Monday afternoon, setting up for what could be a relatively consequential week with a lot of economic data on tap. Now, we should point out that all the major indices here in the U.S. are nursing some pretty strong gains on a year-to-date basis, with the S&P still up about 19%, as well as some of the other indices also up in the double-digit percentages here. With pullback today, 0.5% on the S&P, a little bit more there on the NASDAQ, but you saw the outperformance today on the Russell 2000. You saw the outperformance today with the mid caps. There is a rotation that is in search of value, a rotation that is in search of maybe something that's a little bit more cyclical, maybe something a little bit more economically fundamental. And that brings us back to the economic data that we get this week, because it is going to be kind of make or break, a real sort of look into whether the economic fundamentals are going to be there to support some of that rotation, the economic fundamentals, and whether they're there to support the narrative of a soft landing, particularly at a time when we are still seeing a lot of inflationary pressures out there, including, Scarlett, in the housing market.
Yeah, investors have already placed their bets. We'll see if the data bears them out. Now, as you mentioned, we're going to get numbers on housing. The U.S., of course, is short an estimated 3.8 million homes, according to Fannie Mae. Tomorrow, we get anecdotal evidence from Toll Brothers when it reports earnings. Let's discuss the home builder now with Bloomberg Intelligence analyst Drew Redding. Drew, it's pretty clear when it comes to housing, there's plenty of demand because the U.S. Doesn't have enough supply, but high mortgage rates are holding people back. So what do you expect to see from Toll's results tomorrow?
Sure. So for Toll Brothers, it's all about orders, particularly given, the volatility we've seen in interest rates over the last couple of months. We do expect to see pretty strong order growth for them, but keep in mind, last year they reported a 60% decline. So some of it's optics. Consensus is looking for growth of about 70%, but we do think there could be a little bit of risk to those numbers. It's true that a majority of their peers that reported this earnings season did exceed expectations, but what you have to remember is Toll's fiscal quarter ends in October, so their results are going to include that spike in mortgage rates to more than 8% that we saw. Now, that being said, we're about a month out from when their quarter did actually end, and rates are down to the low 7% range again. So I think even more important than what they report is going to be the commentary during the earnings call in terms of how has demand trended during November and through the first weekend in December. And what I think you're going to hear is that as rates came back down, there was an increase in traffic and an increase in demand activity.
How much are they dependent on the mortgage market, Drew? I mean, given that Toll, at least in theory, it caters to a higher end buyer, at least for a big portion of their homes here, are they still dealing with the situation where the majority of their customers are financing the purchases?
Yeah, it's a good question. So a majority of their buyers are still using mortgage financing. Within the public builder space, they do get the largest percentage of cash buyers. So they are a little bit different and they are a little bit unique. So Toll Brothers won't necessarily provide insight into what's happening in the broader housing market. And they will provide some insight in what's happening in the high end. But as a little bit of context, when we talk high end within the public builder space and for Toll Brothers, we're talking about $1 million houses. That's what their average selling price is now. So we're not looking at the ultra high end of the market. That being said, what we have seen is that the higher end has seen a little bit stronger demand, and prices at the higher end have been a little bit stronger than the rest of the market. The other thing I'd point out when you're thinking about how to extrapolate the builders' results is that these guys operate different business models, whether it's a spec model, whether it's built to order, whether you're focusing on volumes or you focus on price. So I think what we're likely to hear from Toll Brothers is that they're more inclined to hold the line on price in order to maintain margins rather than pushing for volume sales.
Can you speak to the bifurcation in demand between existing homes, which is the bulk of the housing market, and new construction, which is what Toll and these home builders provide? Because we know that as much as people want to buy a home, they're not finding it in the existing home market, and they have no choice but to go to new construction.
Sure. We've been describing the housing market as a tale of two markets for the last year or so. If you look at sales in the existing home market since mid-2022, when rates really started to bite, they're down about 25%. During that time, sales in the new home market are up 25%. So one, yes, it does have to do with inventory, who has the homes for sale. But at the same time, we think that builders have been successful in their use of financing incentives, lowering base prices. So prices in the new home market are down 15% from peak. In the new home market, they're flat to up slightly depending on the index you look at. So when you throw on top of that the fact that builders are able to get rates down to 5.5% now compared to 7.25% at the national level, payments in the new home market in some cases are more attractive than the resale market, which is something we haven't seen historically. So we think that's a big piece of what's driving demand for the builders.
All right, a nice preview there. Drew Redding over at Bloomberg Intelligence. And a reminder, Toll Brothers reports earnings tomorrow after the bell. We'll have full coverage right here on The Close. We're also going to have a conversation with the National Association of Home Builders CEO, Jim Tobin, also on the big program tomorrow. We want to pivot from the home building space and look at the broader M&A sector, particularly when it comes to energy. It's been a big couple of weeks here for the energy sector in M&A, from Exxon Pioneer to Chevron Hess, but the year's not over. You got a lot of folks out there basically saying that you can expect to see more deals before the end of the year. At least that's what analysts over at Truist are predicting. Neil Dingham joining us right now. He's managing director over at Truist Securities. And Neil, let's get right to it here. Pioneer was big. Everyone's talking about that. We talk about some of the other deals. These were mega deals, Neil. Last time I checked, we only got like 3.5 weeks left in the year. You think we're going to see some bigger deals like that coming?
Good. Thanks for having me. The answer is no, I don't think we see bigger, but I do think there's a number of deals that could potentially hit before year end. First, just the amount of inventory that a lot of these publics still have is less than they would like, especially as they end the year, start 24 to show analysts and investors. So I think, first on their plate, if they could buy something reasonable, private or public, I think it's very likely. And then number two, you've just got hundreds of privates. They always love to monetize before the end of the year. So I think there's potentially a couple big deals, a lot of small deals, just a lot of deals overall that could hit before the end of the year.
Well, let's talk about some of those small deals. I was being a little facetious earlier because I am curious about kind of just the maturation of the shale industry overall and whether that's actually driving some of the consolidation that we're starting to see, particularly with some of those smaller and mid-sized players.
Well, it is. It's a great point. Remember, just the maturation alone. Remember, the energy group is different. Most energy companies, they sit still. About 35% of their assets decline on average on years. So they always have to remain active, either organically or externally. So, and then secondly, there definitely is a higher premium for investors placed on the larger companies out there right now. So I don't see a lot of necessarily mergers before the end of the year, but I do see a number of my public companies picking up either private or public assets. Some could be pretty sizable. I think there's potentially one or two. We've heard, rumblings of a company like Crown Rock, which, if it gets done, would be over a $10 billion private purchase by somebody out there right now. So there's some big, crown jewels, as that one is called, out there that I think potentially could get done before year end.
That's great context to provide here, and I think about that because Matthew Monks, one of our M&A editors here at Bloomberg, reminded us when Exxon made the announcement it was buying Pioneer, Chevron, Hess deal, that these are conversations that took place over months. It wasn't like it just happened, even though the announcement came within a few days, seemingly, of each other. Remind us of some of the conversations that kind of have been taking place throughout the year that may just start to come to fruition over the next couple of weeks.
That's right. I mean, you have companies like Conoco, Oxy, Devon, a lot of the large independents that have continually said, look, we're always on the lookout for attractive acres that would go to the upper quartile of our inventory. And I do think there's a number of things out there that could do just that. So to your point, this is things that they've been talking about since the first quarter of this year. Oftentimes, because of seasonality, it's no surprise a lot of things get done right before the end of the year. I don't think this year is any exception.
We were talking earlier about a formerly scrapped M&A deal that may be coming alive once again. Five9 has been exploring a potential sale to Zoom. This is something that didn't work out a couple years ago. And I know we're talking about a different sector, but could we see the revival of some deals that seem to be left for the dead?
Oh, it has. I mean, as I mentioned, the large one, Crown Rock's been talked about probably now for the last couple of years. You've got another even bigger one than that. Endeavor would be, look, if it went tomorrow, could be a potentially $30 billion deal. So that's just two large Permian privates that have been talked on and off, have been, different news sources have put out there, including yours, saying they could go on. So good. There's things $30 billion down to $500 million that I think potentially could get done, again, as soon as this year.
This gets also to the broader question about the government and regulators, antitrust regulators to be specific, and whether they're comfortable with this, or is there the potential that they might try to throw some roadblocks in front of some of these deals?
There's always potential. We saw earlier this year when EQT, that was a little bit of a surprising one, bought just a small deal up in the Appalachia. That did have a bit of a delay. They finally got it closed. I don't see that happening. I mean, in any one of these deals that I mentioned, look, it's not like Conoco and Chevron or Chevron and Exxon are combining and going to have the over 50% of the Permian, the biggest U.S. oil play out there. Any of these deals that happen, whoever buys that is still going to have a pretty fractional share. So I think that those type of standards would be pretty low likely.
What about cross-border transactions? According to the MLive Pulse survey, a lot of investors, 60% of the investors we surveyed expect the dollar to trade lower a month from now. And if the Fed does indeed cut interest rates, that'll be pressure on the U.S. currency. What would that mean for cross-border M&A in the energy space?
You definitely, depending to your point, what FX does, that always does have a large impact. But what I think is kind of evident, look, you had, just to your point, you had two of the majors, Exxon and Chevron, go out and they didn't find international assets they liked better. They didn't, whether that was in Canada or other international areas, they didn't find offshore. They kind of both went in their backyard. I mean, one was especially Exxon, I should say, by doing Pioneer. The other, to buy something like Hess or merge with Hess. Both just showed you, I think they still think the best plays, almost regardless of what FX does, they still think, and I think a lot of others would agree, the best plays are still in the backyard here in the U.S.
All right, Neil Dingman, really appreciate your joining us. Neil Dingman over at Truist, giving us the prospects for more M&A in the energy space for not just 2024, but for this year in particular. Coming up, it's a drumbeat to labor market data. Lara Rames, Chief U.S. Economist at FS Investments, will be joining us as we count you down towards the big jobs report on Friday. This is The Close on Bloomberg.
A big week for economic data, especially on the jobs front. JOLTS data tomorrow, ADP on Wednesday, and the government's monthly jobless claims report coming out, jobless claims on Thursday, and the monthly report coming out on Friday. Lara Rame joining us right now, FS Investments chief U.S. economist, to walk us through this. I don't think I need to ask you which report is the most important. Let's start with the monthly jobs report that we're going to get on Friday. Interesting read here, given the trajectory that we've seen in the past reports. Are we expecting to see maybe a little bit more of a tamping down in the labor market?
So the problem I think we're all experiencing is the trajectory has been fairly sawtoothed. Over the last 3 months, on average, we've gained 200,000, and we had a slightly weaker than expected report in October. Well, we had a pretty strong report in September. So we are really, all of us, searching for some clarity. Clearly, the labor market is losing momentum, but I think you really have to squint today to see signs of real weakness. I call it going from a boil to a simmer.
Okay, well, let's talk about that, because I'm squinting too. When I look at economist estimates saying we're going to get 189,000 jobs, I'm sure you remember in the halcyon days pre-pandemic, that would be a pretty good month. And also some of the other metrics when you're talking about the unemployment rate as well as wages, also holding up, maybe to the Fed's chagrin.
I think that's right. We have had I think one thing that stands out is the unemployment rate creeping higher. It was as low as 3.5% in July. So it really has been a fairly slow move, and that's probably one of the pieces that's getting so much attention. But when you look elsewhere, to your point, it's pretty hard to look at a headline of 180,000, 190,000 job gains and call it weakness. And the details start to really matter here. Wages, we got a very low wage print last month of only 0.2% average hourly earnings. I think that's going to go up to 0.3, but we've had as high as 0.4 pretty recently. The wage numbers are a really big piece of whether or not the Fed can declare victory on inflation. And they are still persistently high when you look at any kind of year-over-year measure.
Right, and when we look at the headline number, 189,000, as Romaine mentioned, it is an increase from the October number of 150,000 because now you're going to factor in people coming back to work following the auto strikes. The resolution of that, we know that the auto workers have gotten increases in pay. Is that going to be a one-off impact on wages, or is that something that's going to persist for months to come?
This is definitely something that we have seen over the entire summer, and I think it's continuing. This idea that companies need to really, I think, increase pay for workers. Workers still feel like they're behind the curve from the inflation that we had in 2021. And the strikes, I think, are important because it even impacts non-union manufacturing. And you see it in other places. You know, companies are reticent to lay workers off. Even if we see hiring slowing, they're clearly not laying people off at the same speed in which I think they would have during prior business cycles. So you put it all together, and I think companies are having to still fight a little bit for workers. They're still treating them like it's a more precious commodity, and that is translating into more upward pressure on wages.
Right, so that's the wage component. What about hours worked as well? Because this is something that also reflects quite a bit in terms of demand and supply and the concessions that employers may need to make to their employees. We're looking at an estimate of average weekly hours of 34.3, and that's consistent with what we saw the previous month in October. What's been the trend for hours worked?
This has really crept down. And I think, you know, back in the day when manufacturing was a much larger piece of our economy, you used to really look at hours worked as a proxy for possible GDP or output. So again, noteworthy that companies would rather cut hours than cut people. I think they want to keep folks in the seat because they had a lot of trouble getting people back in the seat when they laid off too aggressively before. And I think that we see that applying to tech. we really see it applying to other areas where now they're having to fight for and job openings. We're going to get that data on Tuesday. It is still really important to recognize that these numbers are far higher than they were before the pandemic. Middle market companies now have a tremendous amount of job openings that they're listing, more so than the largest companies in our economy. So we're seeing businesses across the spectrum still fighting for labor, and that is a really big piece of the puzzle. And I think we keep seeing that in the data.
I do want to push a little bit ahead. I know this week we're getting a lot of stuff on the labor market, but once we get past that, in addition to the Fed, we do get a little bit more of a read on some of the consumer spending metrics as well as inflation. And I am curious. I mean, the last couple of interesting reports that we got coming out of Black Friday was the increased reliance on credit to buy, whatever folks were buying over that stretch here. And I'm wondering, is that a red flag? Should that be a concern that instead of people going into their bank accounts and taking cash out, that they're turning to their credit cards, they're turning to buy now, pay later to finance these purchases?
This hasn't risen to the level of red flag for me yet. I do clearly think it's something we need to keep an eye on. I think it's a sign that I think interest rates are going to stay higher for longer. And it is a sign that while the consumer may be largely insulated from higher interest rates, we all understand the mortgage story. Other pieces of the household balance sheet, like autos, like the revolving credit of credit cards, are not insulated from higher interest rates. And that piece is going to start to creep in. To me, it just paints a picture of a slower consumer next year than this year, but not yet rising to the level of a red flag.
All right, so watch this space. Laura, really appreciate your joining us. Laura Rame of FS Investments, giving us a preview of what we're looking for when it comes to job market data. Now, still ahead, some of that job market data is coming due tomorrow, so we'll give you an update on what investors need to watch for tomorrow's trading. This is The Close on Bloomberg.